Okay. I hope you are able to see the screen. Can you just put your thumbs or whatever? You're able to see the screen. Can you just
Yes, sir.
put it in a chat whether you're able to see? Yes, sir. Very good. Very good. Very good. Okay. 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 Lokesh is saying, Bhavana Bhagwan is saying, I want to start investing in share market. Narsimha is saying, sir, as a CA student can trade in, invest in a mutual fund, but as a CA, you cannot do trading. Is it right? No, in investment, you certainly can do. That's not a worry. And trading in shares is there. Trading in mutual fund, I'm not sure whether that concept is there. Of course, mutual fund, you can buy and sell. That is certainly possible, certainly there. So let us immediately begin because we have limited time, you know. So what is stock market, friends? Investing in equities is an important investment that can give more returns than inflation, which share market is something which can give you better return than inflation. Stock market is where shares transaction take place in an online mode. Transacting in shares in a simple terms means buying and selling of the shares on an online mode is your stock market. Now I'll be discussing it with a little speed because we want to cover a lot of things in next 40 minutes. There are two types of market: primary market and secondary market. Primary market and secondary market. Primary market is a market where company directly issues the share to public. In a primary market, company directly issues the share to public, right? And what is it, the mode they can do it through? IPOs. So we are seeing a lot of different IPOs: Zomato IPO, Paytm IPO, even recently that Adani Wilmar IPO is going on, and few more IPOs are going on. That is the place where company directly issues share to the public, right? And secondary market is where their company is not involved. You go to stock market, you go to stock exchanges, we'll be discussing about different stock exchanges, and you simply purchase it. You are not aware from whom you are purchasing, or you are not aware whom you are selling it, right? It is a secondary market. Company is nothing to do. For example, I'm buying Infosys shares. Company is not involved into this transaction. Of course, once I buy the shares, my name is entered into shareholders book of the company, and once I sell the shares, my name is removed from the sale of shares. But whom I am buying, whom I am selling is known, is aware when it comes to exchanging the shares on stock exchange. That is secondary market. In secondary market, no transaction happens directly with the company, but in primary market, only in a company and shareholder, right? Who can issue the shares? Only public limited company can issue the shares. Neither private limited company nor LLP can issue shares to the public, right? As SEBI, stock market are regulated by SEBI, Securities and Exchange Board of India. You must have heard about this some time from now. Once the company issues the share, shares are listed on the stock exchange. Once company issues the share, shares are listed on a stock exchange, and then shares are traded further on the stock exchange only, right? So Paytm shares have been IPOs there. Once the shares issued, when the issue opened up, then shares are listed on a stock exchange, and then sale purchase transactions kept on happening on a stock exchange. Post listing shares on a stock exchange, the company shall be called as a listed company. Simple as that. So listed and unlisted company. Even in public limited company, there can be few unlisted companies. It's not needed that every public limited company would be listed company. Jaruri nahi hai. There would be public limited company, but who are not offering shares to public at a large. Those are still unlisted companies, they are called as. Anyone can purchase shares of listed companies on a stock exchange. Simple as that. Why does company raise a share capital? Why? What is the benefit of company to issue share capital? One, very important, no tension of repayment. Because once company issues the share, company can buy back the shares in the future, but that is completely on a management or company's will. That is not compulsory for them. So no issue of, in case of bank borrowings, if company borrows the money for its expansion or for its further use at from bank, In that case, there is always, company has to repay the money, company has to repay the borrowings and all that. In shares, in share capital, there is no tension of repayment of share capital. And one is no principal repayment, and two, there is no commitment of interest or any other committed returns also. So there is no commitment of any particular returns. If you take a borrowings, of course, you need to repay the borrowing principal for sure. But along with that, you need to repay interest also. Along with the principal amount, you need to repay interest also. Shares, there is no compulsion or commitment of repaying principal as well as any fixed returns as such. Funds available for longer term, almost as long as company is in existence. With increased share prices, companies' creditability improves, and all those things happen. One of the major reasons why company normally public limited company goes for IPOs or issue the share capital to public. And the first point of entering into share market is coming up with IPOs, right? Now, what is stock exchange? We are talking about all these secondary market. All these transactions happens in a share market or stock market. What is the stock market and what is the stock exchange? Stock exchange is a place where people buy or sell shares publicly listed companies. It offers a platform to facilitate seamless exchange of shares. Trading takes place on all days except weekend, Saturday and Sunday, and all listed holidays. All trading happens electronically. Market opens at 9:15 and closes at 3:30. Share market is operating only in between 9:15 and 3:30. And during this time, share market prices are continuously fluctuating depending on a demand and supply. The market prices are continuously fluctuating, right? Two major stock exchanges in India, BSE and NSE, Bombay Stock Exchange and National Stock Exchange, we are aware about. Now, what is the IPO? Why people bank comes with the IPO? What is the basic concept of IPO? Initial public offering in which shares of a company are first time open to public for investment. Investor has to apply for IPO of a company during specified period, and based on the company's allotment, they may get or may not get the shares. So in case of IPOs, there are two different things. One is a price band. So every IPO comes with a price band, minimum price and maximum price. Normally, if you want to go for an IPO application, you should apply for a maximum price band. So there would be probably 260 to 272 would be a price band. Normally, everyone goes for a higher price, and then only we get the allotment. One. Two, there is a lot size also. I cannot simply 63 shares apply kar diya, 71 shares apply kar diya. It doesn't happen like that. Company comes with a lot price, and a person has to apply in these lots only. So one lot, two lot. So if there is a lot of say 65 shares or lot of say 25 shares, so you have to either apply for 25 or 50 or 75. You cannot apply for 67. So you have to go in lots only. Then there is something called subscription of shares. So many times you must be hearing that Zomato share is oversubscribed by 7 times. Meaning by Zomato, for example, has come up with 1,000 shares to with IPO, and 7,000 people or 7,000 applications came for the share applications received. I mean, 7,000 share applications received means application received for 7,000 shares. So company wants to issue 1,000 shares, application received for 7,000 shares. So issue got oversubscribed by 7 times is what normally they says, you know. Aditya is asking, isn't it like a red herring prospect? Yes. So red herring prospect is something every company coming up with IPO has to issue, and which has all the details of the company. What are the strengths of the company, when company incorporated, what are the major products of the company, any legal cases, if at all going on against the company, what are the challenges company is facing, everything is mentioned in that red herring prospectus that is available for public. Normally people doesn't go into that depth and to reading that, because a lot of technical knowledge is also there, technical language is there, but that process or that document is available if anyone wants to go in a depth of it. And I strongly suggest you to, at least whether you invest or not invest, but one of those IPOs, you please take that red herring prospect and read it. It will give you a lot of insights you will get out of it. right? After the IPO, shares are traded freely in the open market as at what is known as a free float and secondary market that we discussed. And from there, the share market, share prices are driven by demand, supply, and many other factors. Some interesting IPO facts. Earlier, before Paytm, the biggest IPO was made by Coal India Limited in 2010, where the company raised 15,000 crores through issue of shares. Now, the biggest IPO of Paytm launched 18 November 2021, where the company raised 18,300 crores and it surprised the above record. And few of you, those are aware with the share prices, you must be knowing. Paytm came up with, I suppose, I'm not knowing the exact price, but it came up with 2000 or 2100 issue price. Company issued the share prices, shares at 2100 some odd amount, and now it is trading hardly at 1100. So those of them who Paytm, the biggest IPO in this euphoria, if anyone would have invested into that, they would have lost by today within what, November, the IPO has come, November, December, January, within 3 months, people have lost almost 50% of the amount if they have invested into Paytm IPO. So this is a French share market for you. MRF IPO, on the other hand, MRF IPO is issued at rupees 10 in 1993. In 1993, MRF IPO came at 10. Now it is one of the highest price shares in India. One share trading at 81,000 rupees, friends. So the rupees 10 share that was issued in IPO in 1993, by 2022, probably 30 years, in 30 years, the returns are 81,000 rupees. You can calculate the ROI and all that afterwards. So if anyone would have invested 10 shares of MRF IPO buying 100 rupees, he would have 81 lakh rupees by now. So this is a possibilities of share market with us. Essentials of stock transactions. For you to do stock transaction, there are two essentials. Two important things are needed for share market transaction: trading account and demat account. So understand, friends, these are two different things: demat account and trading with a stockbroker. You have to have both for trading into share market, for doing transactions into share market. What is trading account? A stockbroker operate under the guidelines prescribed by SEBI, sorry, my bad. SEBI. Like we have different banks for banking operations. Similarly, there are different stockbrokers. Many stockbrokers are there, and online and offline, lot of stockbrokers are there. Stockbroker can operate under the guidelines by SEBI. Investor has to open trading account with a stockbroker. One can have a trading account with one or more brokers also. There can be more than one broker accounts, trading accounts also. Trading account helps you to carry shares, sale and purchase transactions in the market. Examples of stockbrokers are Motilal Oswal, Anand Rathi, Zerodha, Upstock, Grow, and all that. You must have heard about a few of these names. Many of these are already unicorns. What is demat? Is dematerialized account. The shares that you have, friends, probably 10-15 years earlier, they used to issue shares in a physical form. Now there is no more physical shares available for any company. All the shares are available in electronic format, and which is stored at a place called demat account, dematerialized account. Shares which have been dematerialized into that account. Trading on stock exchange happens over the internet without physical intervention. Shares represent investment held by market participant. They get stored into demat account. Shares get stored into demat account. In other words, demat account is an online account where the records of holding of shares are maintained. In order to trade electronically, opening of a demat account is mandatory. Any physical share you have shall necessarily be converted into demat format. Many of them who are kind of trading into share market from say 30-40 years, before 2000, shares were in a physical format. So though if at all anyone had that physical shares, they had to convert it into demat format. Total number of demat accounts opened in 2020 was highest in any year in last decade. 2020 was a pandemic year. People were sitting at a home, and that was the highest number of demat account opened. Almost 50 lakh new demat accounts opened in 2020. 50 lakh new people entered into share market, and that is the reason this session is for. Everyone is kind of going in this bus. Everyone is riding on this bus and we cannot really miss the bus just because we don't have the knowledge of the same. In Jan 21 alone, 17 lakh demat accounts are opened up in India. 1 month, Jan 21. More demat account means more investor in market, means more money pumped in stock market. Even in pandemic and financial crisis, there is a huge jump in number of new demat account. The most common reason and all that is okay. This is also okay. Just a different thing about demat account. Now, interesting thing is, do you know Lord Balaji has his own demat account? So next time, if you go to that Lord Balaji, instead of putting that money into that hundi, you would have done any time, you can simply donate your shares also. So the world's first demat account of deity. The account is fully functional and devotees can donate shares into to the Lord through their this thing also, demat also. Now, friends, in share market, there are two different concepts. Face value and market value, right? So normally shares are issued at the face value of 1 rupee, 2 rupee or 10 rupee. Normally nowadays maximum face value of company is 10 rupees. Face value is the actual value of company of the shares in the books of a company. But market value is a value which is getting traded at a stock exchange, right? So if you'll see currently ITC shares is 2002 on a in a market on a stock exchange. I mean 2002 was a price when this presentation was made, while its actual face value is only 1 rupee per share. So 1 rupee per share is actual face value. However, market value can be much different than the face value, right? Then there is something called Sensex and Nifty, right? What is Sensex, friends? Sensex is a stock market indices which represents Bombay Stock Exchange. Please understand, Sensex is only relating to Bombay Stock Exchange, and Nifty is relating to National Stock Exchange. So what is different between Nifty and Sensex? I'll just tell you. Sensex represents the 30 largest and most capitalized companies on Bombay Stock Exchange. Normally share market movement on BSE discussed in terms of Sensex. So market kitna upar gaya, kitna niche gaya is discussed in terms of a Sensex, because there are thousands of companies listed in a stock market. So how to derive the actual market indication, how to understand actual market indication? So what they did is largest capitalized companies. What do you mean by market capitalization? Largest market capitalization. Largest market capitalization means it's a simple formula: market price of the shares into number of shares issued for any company, right? So today TCS, Tata Consultancy Services is the most valued company in India. Its market capitalization is highest, right? Tata Consultancy Services. So how is market capitalization is derived at total number of shares issued by TCS in a market, total number of shares issued in a market into today's market price. So many times what happens is sometimes TCS is the most valued company. Sometimes Reliance is the most valued company. Sometimes probably Infosys can be most valued company. Why this most valued company changes? Because their market capitalization changes with the changing in market prices. If Reliance for that matter sometimes come down heavily, then its market capitalization also comes down heavily, right? And someone else can go ahead of Reliance in case of market capitalization. Number of shares issued into share price on a share market in a Bombay Stock Exchange. So recently these were the 30 different companies listed on a included into Sensex on a BSE, and from different sectors, If you see Infosys from IT, TCS from IT again, Reliance from integrated oil and gas, ICICI Banks, HDFC from banking industry, HCL is from IT industry, Bharti from telecom industry, L&T from construction and engineering industry, ITC from cigarette tobacco products industry, Axis Bank is there. These are the different companies, Titan company, other apparels and accessories industry. So they somehow try to include companies from all the industries which are having the maximum market capitalization on share market, and the whole market performance is being discussed in terms of Sensex. So Sensex is for 30 company, Nifty is for 50 companies, right? So this is these are different companies. Nestle, again into that 30 companies, packaged food, cement. Ultratech is into cement, Sun Pharma is into pharmaceutical, Bajaj Finance is into finance, Maruti is into automobiles, HDFC. Understand HDFC, there are two different shares of HDFC. HDFC Bank is different and HDFC company is different. There are two different companies listed on a share market as far as HDFC is concerned, HDFC Bank and HDFC. Kotak Mahindra into banks and all those things are concerned, you know. Okay. And when it comes to Nifty, Nifty is a stock market indices which represents National Stock Exchange. Nifty represents 50 of the largest, most capitalized companies on NSE. So Sensex, they have 30 companies. Nifty is a little broader and it has a 50 companies included into Nifty. So normally they says Nifty gives a little better picture of a market because 50 companies are included into Nifty, and it gives little broader and better picture of a market is what normally experts says, but many times they almost go hand in hand. They almost go hand in hand. Normally share market movement on NSE discussed in terms of Nifty. Nifty gives little broader picture than Sensex as it covers more companies, right? And of course, majority of Sensex companies are there into Nifty and few more. And few more also like Reliance, HDFC, Infosys, ICICI, TCS, all those companies are there. For Asian Paints is there. So because these are 50 companies, there are little more companies. JSW Steel probably I think is not in Sensex, but in Nifty, right? Like that Nestle, I suppose, I am not sure whether it is in NSE, Sensex or not. Grasim certainly is there in Nifty, not in this thing. And this keeps changing. Depending on their market capitalization, this keep changing, right? So these are different Nifty companies. Bharat Petroleum, ONGC, Britannia Industries, Shree Cement Limited, Hero, Eicher, Coal, Indian Oil Corporation, so on and so forth. Ramesh is saying, sir, I have received Zoom link now. Why so much delay? Already you have started the class. Ramesh, we are sending you emails also. This is an additional class. This is not a main class. Main class is starting at 3 o'clock. Basics understanding of share market, and which is not a compulsory. That is a voluntary for everyone. And that a link was already sent to you by email yesterday itself. You know. Then there is something called dividend. Two ways you can get returns from your share market. One is through appreciation into share market prices, and two through dividends. Many companies keeps giving dividend, but issuing dividend is not compulsory for any company. Issuing dividend is not compulsory for any company. It is absolutely at a will of a management. It is absolutely at a will of a management, and only shareholders can get dividend. Please understand there is a difference between shareholder and director. Shareholder is a owner of a company. Up to the extent of your shareholding, you are owning that company. So tomorrow you can proudly say if you have Reliance share and Mukesh Ambani, both are shareholders of the company, both are owner of the company, right? That is something you can proudly tell everyone. But shareholder is the owner of a company, and director is the one who is managing the operations of the company. Shareholder need not to be director, director need not to be shareholder. So director is one who is managing the company, who is managing operations of the company, who are taking decisions on behalf of shareholders to run the company, to do the operations of the company. So dividend is a distribution of profits by any company to its shareholder as it is determined by company's board of directors. So dividend is a decision of BOD, board of directors, and then only dividends are being distributed. Many companies do not pay dividend and instead retain the earnings for further growth of company. So many companies, instead of distributing the dividend, they retain the earnings. They keep the earnings or profit in the company itself and use it for companies further expansion, further development, new changes and all that, new initiatives. So for all those purposes, normally companies maintain the share, don't distribute the dividend and keep it in the company itself. You know. Okay, so this is basic about share market operations, transactions. You can open Demat account into any company. There are enough YouTube videos available on video how to open a Demat account. And I think many Demat companies gives Demat account for free of cost also. Few companies charges you for Demat, and that is a small kind of charges per annum. They charge anywhere between 200, 300, 500 rupees, varying from company to company. So you can always open a Demat account. Please understand, for you to do any kind of transactions or work into share market or stock market, you have to have Demat account. Demat is first entry point for yourself, and it's not very difficult to open it. You can always open it and anything. So that is not a bad idea for all of us to just keep the Demat account open. Those of you, few of you who are operating on Zerodha, they can just contribute. I think many of you knowing that Zerodha, to my mind, and many of these people are giving Demat account for free also. I think a lot of these new online stocks are coming up. They are giving the Demat account free of cost also. You know. So that is about Demat account. Let us, because few of them initially talked about a few share ratios analysis and all that. Let me just see, because we have 10 more minutes. Can I discuss about a few ratios here? Just a moment, I'll just check. Okay. So I'll stop share this and sharing something else. Meanwhile, any one of you have any questions on whatever we discussed till now? You can put it into this thing. Which one will you prefer, Upstock or Zerodha? Vinayak, I really don't know, because I am a kind of old philosophy person. So I have my Demat account in one of the banks. But I think operationally both are good, I suppose. Both are good. Many of them have in Zerodha also, and Upstock, Grow, and lot many new companies are there. So you can really open it in any of those this thing. Okay. Any other questions if you have, sir? Okay, till then I'm just sharing few ratio. I mean, there are quite a bigger amount of analysis that everyone needs to do when it comes to share market, but still a basic few things that we must have learned this in our studies also, in our CS also. One most important thing is EPS. EPS is earning per share. Earning per share. What is the total earning of that company in that particular period? It can be quarterly, it can be, EPS can be calculated quarterly, yearly. For that matter, every listed company mandatorily need to declare their results every quarter. It's mandatory. Every quarter companies need to declare the results. So if you're reading newspapers or some other places, things, they will say in this quarter this company's share have been profit has been jumped, it is more than estimation, less than estimation, up to estimation, whatever is this, right? Jawahar is asking if a company is listed on both the markets, so there will be separate market capitalization. Marginally, yes, because because the share market prices would be almost similar in both the markets. It doesn't have any change. Very 0.00012% is what small change is there into BSE and NSE. Normally, the share prices go hand in hand. So EPS is total earning in that particular period divided by number of shares. So here right side I have taken an example. If any company has issued 10,000 shares, 1 lakh shares to the public, and this profit is 75 lakh rupees in that particular period, whether it is a quarter or a month, year, whatever, the total EPS is profit divided by number of shares is 75. 75 is a EPS of that particular company, right? Earning per share. And P ratio is price earning ratio. Price here typically is called as market price. Market price divided by EPS. EPS is earning per share. So if any companies say, imagine the same company we are talking about is it's a share price on a market today is a 4,500. Imagine 4,500 is a market price today. So 4,500 divided by 75. 75 is EPS we had seen here. 4,500 market price divided by EPS of 75 rupees. The PE ratio of that particular company is 60. Aditya, I think there is some design that is happening on Excel. So P ratio of that company is 60. So P ratio 60 means what? Typically this says as multiple of earnings I am ready to pay as a price. So 60 times more I am ready to pay for that company than its earnings. Are you able to understand this? Market price divided by EPS. I am ready to pay 4,500 rupees for a company whose EPS is only 75. So its earning per share is only 75, but I am ready to pay 60 times more for that company's shares if I believe that that company would perform better in their future. So, and of course, P ratio always is in a range of 30, 40, 50. Every company's P ratio is different. Every industry or sector's P ratio is different. Best part is there are enough data available on a Google, on a different platforms, giving you P ratio of that company. Then you, if while purchasing, these are the two important ratios, very important ratios that we need to look into before going to purchase the shares, before going into purchasing of the shares. And you to compare the share price of that company with other this. So one is you can compare P. Here it is there. You can compare its company's P with its competitor P in the same segment. So for example, Infosys and TCS are competitors. So you can compare Infosys P with the TCS P and you can understand the performance of Infosys if you are willing to buy Infosys shares. Then there is something called industry P. I mean, technology as an industry, its P is also available on platforms. So industry P you can compare it with. Then you can compare with Nifty or Sensex P, meaning by how Nifty P is performing, because Nifty is having a combination of companies from different categories. So it has from automobile, it has from FMCG, it has company from retail, it has company from infrastructure. So overall, how this company's PE is performing in comparison to Nifty P. Is it so happening that Nifty P is going up and up? Continuously Nifty P is growing, but this company PE is going down. Now, if that is the case, that means there is something wrong as far as this company is concerned, because all companies PEs are giving better PE, but this PE is not that great. So you can compare Nifty P. TTM P, my mind is 12 months earlier. I mean, just 12 months, past 12 months, right? Trailing 12 months or something, long form of that TTM. But just past 12 months PE is also available for that company. And then estimated PE is also available. So you can compare all these different PEs. And again, I mean, these charts are available. There are a lot of different, this Upstock, Zerodha, Grow, Screener, Money Control, lot of these platforms are available wherein you can compare this different PEs over there, you know. Then of course, debt equity ratio, we all know, we learned in our this thing, debt borrowings of loan or share capital. Normally, as we all know, debt equity relatively better, good debt equity is 2. If the debt is twice equity, then it is still a good company, they call it as. But if the debt equity ratio is more than 2, I mean debt or borrowing are more than double the share capital, then it can be little riskier option. Then companies can be called as little riskier option, you know. So this is what is debt equity. So PAT is profit after tax. EBITDA, we all know, earning before interest and tax and amortization. So these are, I mean, there are many more analysis and comparisons and ratios are there. I just discuss here the main important ratios that you can consider before going into purchasing the shares. You know, few questions are there on the participant. Sir, what the basic areas we should check before investing? Interesting question, Drusha. So how I started my investment, I'll tell you. Simple thing I'll tell you. And my request is those of you who can start your cameras, that would really uh, better for me, because I love seeing the people, you know, talking, seeing the people. So I see it this way. Last time we discussed that India's growth story that is going to come in next 10, 15 years, right? India is going to be third largest economy, and the Indian economy is going to be close to 10 trillion in next 10, 15 years or something like that. Now, my basic question to you is, and that's how we'll analyze what are the best shares to invest into share market. If I want to start investing into, right? What are the good shares? The first and foremost, very important thing. There are two type of trading that happens on a transaction that happens on a share market. One is delivery share market, where is you purchase it, hold it, and sell it after, right? You are holding it, is a delivery. And F&O or trading means, last time Nishit sir was discussing about trading of the shares and all that. Trading means you are buying it and selling it into F&Os. Honestly, I am also not very clear, or I don't trade into that. I don't go into trading of that. So I have also a very limited knowledge. I purposely kept out of it because it is as good as kind of betting, or of course there are a lot of analysis and a lot of study which undergoes into that. So yeah, we cannot say it is just like a lottery. There is a lot of study that happens behind that, but I never entered into that market. But there are two different there are two different ways through which this transaction happens in a share market. So in delivery, I would strongly tell all of you that those of you who are interested in investing in long term, don't invest into delivery market just for 5 months, 6 months, or a year. Because if you purchase invest it only for 4 5 months or 6 months, and when you want to buy it sell it after 6 months, chances are if the share market is down by 10-20%, you will end up making loss into share market. So invest only if you are having a longer perspective. Longer perspective is anywhere above 4 or 5 years, right? So coming back to my discussion, India saw the growth story for next 10 to 15 years. Can you put it into me chat and let me know what are the major, say, 5 or 6 sectors you feel would be growing a lot in this economical change? ये जो economy बढ़ने वाला है, which are the sectors which you think are the best sectors? So power, EV, technology, sugar, AI, pharma, software, EV, IT, chemical, tele, right? Many of these. EV is the most happening thing, we all know, right? All these sectors are there. So we know these sectors are going to grow like anything. So I mean, see the interesting part. The 30 companies which were there into Sensex in 1990, when that Sensex was there, many of those 30 companies are even not even today into that Sensex companies. The 30 companies into 1990, hardly there is 1 or 2 companies would be there into Sensex 30 of today. So in 30 years, many of the companies replaced with new age categories. So exactly what the way you're saying into your chat, AI, EV is the new thing that is coming up. So we all know this particular segment is going to grow like anything in coming to this. Now, my simple as a layman investor, what I think is, say for example, EV. EV is the happening thing that is going to happen. One or two, for that matter, I think hardly anyone would have told that banking sector is going to go, because all these 10 trillion transaction, where will this happen? Where will this transaction take place? Only in banking, right? Technology is going to increase, banking is going to increase, infrastructure is going to increase. Infrastructure बहुत ज़्यादा होने वाला है. So today they says in India, I mean, So there are different aspects. Packaged food per citizen, packaged food ordering in India today is hardly somewhere close to 3,500 or 4,000 rupees in an annum, per annum. I'm talking about packaged food per capita, packaged food per person, packaged food in India in a year. And the same ratio for USA is almost 1,50,000 rupees. Can you see the gap? Can you see the growth potential? So that is again one of the packaged food is another growing industry which might have huge potential. Like that, there are different industries. Now, as an investor, what all we can do is, if EV, I believe, is going to grow like anything, I will find out what are the top 2 or 3 EV companies into market. This is Tata Motors is a good EV company. Tata Power is going to help out into EV a lot. If that is the case, then I will just, whatever sectors I feel is going to grow like anything into next 10-15 years, I will find out top 2 to 3 companies into that sectors. I'm giving a very layman thought, very layman thought. And for example, banking is going to grow. What are the top 2-3 companies into banking? Say, for example, SBI, HDFC. From private company, HDFC is top company. From public sector companies, SBI is the best company. Now I simply will go and buy those shares, because whatever prices today they are at, I'm damn sure these prices are going to grow anything in next 10 years, because the whole company's market capitalization, it's Bajaj Finance, for that, friends, I mean, just 4 or 5 years back used to trade it anywhere between 200-300 rupees or something like that, and today it is anywhere between 7,000 or 8,000 rupees. So that is how investment happens in a share market. So I think the next year someone asked, how do we decide which shares to invest in? So this is just a layman thought. What are the top sectors I believe will perform in much better way in next 10 years, and in those top sectors, what are the top companies? So that is very less risk, very ekdam kam risk mein you will get good returns only if you invest it for a longer duration, for long term, right? If you go into for 6 months, so you invest only those amount which you're having, you can keep it aside for a longer duration. So you can start with, say, 500 rupees month, 1,000 rupees month, 2,000 rupees month, and Nitish will be discussing about mutual fund. So if you still have little fear about share market, you can always go into mutual fund with, and all these benefits of a share market you can rip from mutual fund also. Today market is anywhere between 60,000 or so. There is a lot of discussion and debate happening that whether market will reach to 2 lakh anytime. And as I said, I hope last time I discussed with you, in 2006, I still remember that news that India market first time crossed 6,000 and Sachin Tendulkar to the 200. Remember that? So in 2006, market was below 6,000. In 2003, market was 3,000. Today it is 60,000. 20 years. So then what stops us from believing that it will not cross 2 lakh in next 10 to 20 years? And that's the reason I'm telling you are the luckiest generation, not only from career point of view, but investment point of view also. Any other questions, if there are any? Which is better, BSE or NSE? I mean, Prajwal, to my mind, again, I'm not a very S investor or this thing, but you can invest in anything. I think, I don't know whether you have that option also or not. The broker you go with, they invest into this thing. That is not very big deal. Why the price of stock market fluctuates so much, on which? So Kavita, there are different factors of fluctuation. I mean, Russia ने येमेन पे एक मिसाइल छोड़ दिया ना, खत्म, tomorrow share market गड़गड़ हो जाएगा. I mean, that Tata Motors is still producing the same kind of cars, that TCS is doing still same thing. It's majority coming out of emotions. The third wave of this thing started just because of third wave. In first wave, 24th March 2020, right? Market collapsed like crazy. In March, April, May, market collapsed like crazy. So there are a lot of different things. Those are there. Now the US federal rates are going to be out. Interest rates are going to be out. That is also marketing waiting for. And because there was a grapevine that rates are going to increase, market already collapsed. So in last probably week's time, market collapsed by 10 or 12% or so. So it depends on a lot of different factors there. Why our market sentiment relate to other countries' stock market? Now today, Kavita, we are sitting in a global village. You cannot isolate yourself from global market. In fact, global market impacts a lot on this. So, I mean, it's absolutely related. Absolutely. US market is collapse. There are few dominating markets in the world. So if the US market is collapse, suddenly other markets will also get impacted due to that, you know. So it is certainly related. You cannot really isolate yourself with that. Sir, can I get yes, Bhagwan, you need to just send a message to that number. You will be able to send it. So yes, friends, 248. I hope you would have got little knowledge about whatever share market, and that fear would have little gone. My strong suggestion, and I'm putting myself into your shoes. You know, if I would have been a student, keep saving small amount monthly. You can start it from 200, 2000 to 2000 to 5000, you know. And today in next session we'll be discussing about few other investment options also, but share market is something you can start investing from small amount, 200, 500,000 or so. That will really make a very good amount of wealth, because this is jitna jaldi aap chalu karoge, earlier you start investing, better it would be for you, right? So I think we will take just 5-10 minutes break, and then 3 o'clock the session can start. I'm not sure if the link would be probably same. If the same, then those of you who want to be here can be here, and you can again join at 3. The last question I'll take: is there any absolute truth that we can rely on technical analysis, sir? Kavita, many a times technical analysis also fails, and many a time, that's what I'm saying, technical analysis are super, very strong technical analysis. But if tomorrow Russia launches a missile on Ukraine, whole market will get collapsed. Now, technical analysis is very good. So you cannot rely on either of it. There is a lot of different. So that's why I'm telling time and again, from long-term perspective. So as I said, 2003 market was 3,000. Today it is 16,000. In between 2008, Lehman Brothers scam happened. Nirav Modi happened. You know, pandemic happened. Demonetization happened. All these things happened. So market has seen a lot of these different things. Still market has grown from 3,000 to 60,000. Benefit of long-term investment, right? Hope this was useful to you, friends. I'm not sure, but try to make it a little more comfortable with share market. Try to take your fear out of the share market. Please don't fear it out. We are finance student. In fact, I always say our अपना right तो पहला है share market पे, being finance student, you know. So we should take benefit of a finance market at its best. This is a very small discussion we did. Lot of things are available on internet. You can go through that, but please don't fear away or keep yourself away from share market if you want to invest, right? जबरदस्ती इधर उधर, and don't borrow and invest. आपका खुद का सेविंग है लॉन्ग टर्म के लिए तो इन्वेस्ट करो. पंकज ने बोला बहुत अच्छा है, बहुत अच्छा है, बहुत अच्छा है, इससे उधार लो, उससे उधार लो, उससे उधार लो और करो. No, never, you know. So thank you so much, guys. You can hang on here also, or you can join after 5 minutes also. Achha, meanwhile, one small thing for you. I'll be doing it again in that session, because we have 3 minutes. You please take out your mobiles. I have a small request for you, because this sessions for Wikimantra. You please take out your mobiles. On mobiles, we have a YouTube channel of a Wikimantra. Now, the small fees for this additional session, want to take it from you is, please subscribe to Wikimantra YouTube channel. Do it right away. Wikimantra channel is there. So if you are done with, you can put done into this thing. And like that, YouTube is there. Done, Narasimha, Naga, Santosh, Balki. Because on this Wikimantra page, in this YouTube, on Insta, FB, and LinkedIn, we are posting a lot of this good financial awareness related contents. We are launching a lot of financial awareness related content, which will really help you a lot to understanding these topics, and small topics. So YouTube is one thing. Those of you who are done with, please go to Insta and FB also, and please Subscribe to Insta and FB also. My earnest request to all of you is Zerodha or Upstock is better or Grow is better. I mean, honestly, I am not using it, so not sure. But you can go into reviews on Google review. Kavita is saying Zerodha is better because probably she's using it. I also heard a lot about Zerodha, but then all these apps are trying to compete with each other and trying to give as best as possible. Please subscribe to YouTube, Insta. Uh, done. Thank you, Pushpam. Thank you, Pramok. Thank you, Kavita. Thank you, Dhruti, Vinayaka, Ashwini. So nice of you, dears. So nice of. And please do it to Insta and Facebook also. Please do it to Insta and Facebook. LinkedIn is also there. Please do it because we are continuously, probably twice or thrice a week, we are posting continuous inputs about in March, and which is says the kind of mother of all the IPOs, one of the largest IPOs where world is looking at. I'm telling you, world is looking at one of the largest, not only in India, in the world. So we'll be putting it a lot of interesting inputs about that IPOs into the share market, other places, other investment options, and all that. So it would be so nice if you can subscribe. YouTube, Insta, FB, and LinkedIn. These are the 4 places we are at as of now. Thank you, guys. Let us just break here only for 2-3 minutes. I hope this is the same link. So let us just get fresh and all that. 3 o'clock exactly will start again. Requesting all of you who has not subscribed to these 4 of them, LinkedIn and all that, please do that. Thank you. Thank you. Thank you. Hey, happy afternoon, guys. Happy afternoon, Nitesh.
Yeah, happy afternoon, Pankaj. Happy afternoon, all.
I can. Happy afternoon, guys. Can few of you start your cameras? Happy afternoon, Santosh, Chandan, Tara. Wish you had a good weekend and last week also. So continuing to our last discussion, friends. So last time we discussed about share market, started a share market. And as I discussed in the beginning, Vijay Raja sir had three important objectives of these 3 Sunday sessions. One is your personal investment and personal financial discipline. Two, you being a finance student, how can you help your family into investing better, into making better financial investment? And three, how we just not become a consumers of a whole economy now, that how can we become a contributors also, how can we become a contributor, contributing in a different aspect in a nation, to the nation. So these are 3 different aspects that we'll be discussing over these 3 Sundays. So we started with the share market last time. Today Nitesh will be taking remaining slides of a share market, and he'll be discussing very important about mutual fund also. We just completed a session 10-15 minutes to 5 minutes back, and there we ended this up with that if at all we have a little concern, worry, or worry about share market, how to do transaction in share market, how to track the mood of the share market, how to be in a profit in the share market, if there is a still little doubt, or we don't still doesn't get the courage to start in share market, mutual fund is a place for you. Because in mutual fund what happens is, different companies, different experts are sitting there, and they are taking money from you, and at a small minimal cost of say 0.5 or 0.1% expense ratio, they are investing money into share market, taking it from you. Right. So Nitesh, my request to you, when you're investing about talking about mutual fund, please discuss the basic modus operandi of mutual fund also. What is fund manager? How does this happen and all that? Because then everyone will get idea, comfort, and confidence about share market. Sorry, mutual fund. And probably 50 minutes or 60 minutes Nitesh will take. And from after that, we'll be discussing about different investment options that are very much relating to you, and also to your family. Major focus is on a family plus you also. So we'll be discussing about 4 or 5 different investment options over there, right? So over to you, Nitesh. You can begin, please. Thank you.
Yeah, yeah. Thank you, Pankaj.
Let me see if you're not able to unmute yourself.
Am I audible?
Audible. You are not audible. Yes, please.
Yeah.
Please continue.
Yeah. Good afternoon, Pankaj, and good afternoon to everyone. So first of all, I would like to welcome you again to the extended part of our previous session. So to brush up what all we have discussed in the previous week. So if we put it to cut the long story short, our discussion was majorly focused on the behavioral aspects. So when it is very clear that there are very little things that we can control against the things which we can't control. So the best thing we can do to ourselves is to control ourselves. So in this line, we have discussed a certain number of good practices to cultivate, and we were discussing certain number of avoidable practices, or in other sense, don'ts in the equity market. So we have discussed 5 of those things, and now let me continue with the 6th one. Pankaj, can you please enable me to share the screen?
Now you would be able to.
Yeah, thank you. Yeah, is my screen visible to all of you?
Yes.
Yes, sir.
Yeah, thank you. So this is one of the major things where even I myself did this blunder. Never rely on free tips, because if you go through the Instagram, there are 10 many posts saying that this is going to be the next big stock, and they will every fortnight or every month they will give a new list of some 15 shares and say that these are hold forever. Every 15 days, the list gets revised, but the tagline remains the same. These all are the stocks to be held forever. These all are the stocks. Budget ke liye they will give 10 stocks. On Deepavali, they will give Muhurta stocks. On every new festival, they will give a list of new stocks. But all of them are there throwing it free of cost. That means they are simply propagating certain stocks. So my request to all of you is never ever rely on free tips. Why? Because in this world now, as such, there is no free lunch. If there is something that is there which is absolutely free, then always remember that you are the product. So they are not intending on the stock, rather they are intending on you. Let me share my experience in this regard as well. So there was a time when I was not even I had not even joined my job, but I was putting my scholarship money into the trading. Then I came across a Telegram channel, and that guy was from Bihar. There was a town named Samashtipur in Bihar, and that guy was from Samashtipur. He said that pay me some amount per month, then I will give you some calls. Depending on those calls, you can take positions, short-term positions in the market. By actively trading, actively buying and selling, according to his instructions, I can make good money. Like any random individual, I also fell for the trap, and even I paid him a monthly fees of 1 month. For 1 month, he was charging some 7,000 to 8,000 rupees that time, and I paid that money. But after a period of 15 days, my experience was literally very bad. So he used to give so many rockets signs in his Telegram channel, and he used to say that you will have a risk reward ratio of 1:10. I was not even in a position to understand what does that mean if it is a risk reward ratio of 1:10. Later I understood that a risk reward ratio of 1:10 means for every 1 rupee of risk you are willing to take, you have a potential of earning 10 times of that. So the thing is absolutely ridiculous, and it was superficial expectations. So that was the modus operandi using which they used to trap innocent people like me that time. So I paid 8,000 rupees. I took a risk of 1, but I never earned that 10. Rather, I lost my capital. Though not fully, a significant amount of my capital was lost because of that particular Telegram channel. And next thing is never ever be a victim of pump and dump schemes. This is also one of the sin play that is going on in the market. And there is a guy from Hyderabad whose name I don't want to take, and he runs a Telegram channel. In a Telegram channel, there are 2 lakh members. Imagine now we are some 100 participants here. In his Telegram channel, there are 100 participants. His modus operandi works on this way. Say if there is a company named XYZ, and it has been inactive in the market since so many months or so many years. So it is a penny stock, and hardly anyone buys or sells those shares. What this guy does is, before giving a call in his Telegram channel, he accumulates those shares. For example, the said XYZ company is trading at rupees of 8 rupees in the market. He buys some 50,000 quantity of that XYZ. When he buys 50,000 quantities of for 8 rupees a piece, then he will be investing 4 lakh rupees. Using that 4 lakh rupees, he will be accumulating 50,000 shares of XYZ, which is a penny company, and there is no fundamentals and nothing. It is almost like a dormant company, simply listed on the market. Then what he does is, once he gets accumulated with the sufficient quantity in his Telegram channel, he will give a call that this is going to be the big stock. Say if it is now it is trading at 8 rupees, it will go to 20 rupees in short period of time. So my dear students, all of you, please accumulate this. And all those innocent people believed that our sir has given this tremendous call on this XYZ company, hence I am going to buy that. So when the liquidity is very less and people are rushing to buy, then the price is obviously bound to increase. When the price is increasing, this is the same guy who has given the free tips is also selling that share. So I have accumulated 50,000 shares at 8 rupees a share. Then after accumulating, I will give a call in my Telegram channel, a free channel, where I give a call that XYZ is going to be a great company. So buy this. Then out of 2 lakh people, even if I consider 20% of them are rushing to buy that stock, the price will obviously go high, and it may go to 20 rupees or 25 rupees. And using that, this guy will make his exit and he will make profit out of it. So this is why I said, if it is free, then you are the target. So never ever rely on such free tips. And also we must note that we all have come across Mr. Warren Buffett, who is one of the richest man ever lived in this earth. And we also come across Mr. Radhakishan Damani or Mr. Rakesh Junjanwala, who all made very good fortunes out of stock market. But we must note that none of these guys relied on free tips. They did their hard work, they did their primary research, and they had the courage, they had the common sense, and they had the conviction. Depending on these elements, they built their fortunes, and their empire is not built on any free tips as such. So always stay away from free tips. And finally, nobody will teach you the art of making the money. It has to be learned on your own. So that even if you are I'm a student, consider me a student. A lecturer will teach me the subject. He will teach me how to prepare for exam, but it is me who has to write the exam. Hence, never ever expect anyone to come to you and give some free tips so that you can become a millionaire. This is one of the major mistakes I think many people will do. Why? Because I also did, and some of my friends have also done the same mistake in our student days. Next thing is never invest into penny stocks. So this penny stock is like a mafia. There is no way out. You can only enter, but you can hardly exit. Why? Because every penny stock has a market capitalization of less than some 100 crores, 50 crores, 60 crores. When their size is so small, their name is unknown. So obviously there will be no one to buy and sell those shares. And these are the companies, or these are the small shares where people fall into the trap. They buy because of some certain news or certain actions, but they will never ever be able to make an exit. Here on the screen, you can see a stock named Quality. This is not the Quality Heart ice creams. There is another company named Quality Limited, and this is my own experience. And it was in 2018 November when this company posted its results that it has clocked a sale of rupees 1,500 crores in a quarter. So you can see somewhere between July 18, the stock saw a little spike, V shape you can observe here. So that rally was because the company had reported a sale of rupees 1,500 crores. Many people bought that, and many good friends of mine also bought that share. But after one more quarter, the company said in its next quarter result that out of the 1,500 crore rupees of sales that we have clocked in the previous quarter, now we are reversing 1,200 crores. That means we did our sales, but it got returned. But if we apply our common sense, then it is pretty much evident that this was not at all the genuine sale. The promoter had to dump his shares, so he floated a dummy figure. General public believed and bought his shares. Now he said that no, that was not the actual sales. The sales has been reversed. Now all those people got trapped. Now if you can see the levels here, stock raised was so high. The peak of the stock was 165 rupees. Now stock has hit the low of rupees 1.3. Imagine the kind of level of destruction this stock has done for the general public. So always stay away from the penny stocks, because it is like a mafia. In a typical mafia, you can only enter into the underworld or the mafia, but there is no way you can come out of the mafia. So always stay away from the penny stocks. Next thing is never invest on the big on news. Have a company displayed here, and I would like to ask you people, in the last 3 years, how many of you have come across positive news relating to the Yes Bank. Warren Buffett is going to buy the stake. Some Canadian billionaire named Irvin Singh is going to buy the stake. Bank of Singapore is going to buy the stake. Goldman Sachs is going to buy the stake. So many newses I have come across. Can you please drop in the box? Yes. If you guys have also come across the positive news. Only one. Yes. And in chat box, some of you said about the investment by State Bank of India. The thing I would like to bring into your notice is that State Bank invested into the Yes Bank only after RBI put the bank into the moratorium. Prior to that, there were so many newses I came across with. Those were the times when stock this Yes Bank was trading near 400 rupees. Those were the times from when these newses were circulating. So this was the last nail on the coffin. State Bank of India making investment into the Yes Bank. That was the last part of the story. Prior to that, there were so many newses being floated upon. Even if you see on the chart, after 2018, there becomes a drastic fall. After that fall, every spike you see here, that is only because of the news. Why? Because people saw the business channels and people came across some social media posts or some across some Twitter. They said that this guy is going to invest and that guy is going to invest. People blindly believed and invested big money. So always remember that never invest big on stock when it is in limelight. Why? Because if it is in limelight, chances are more that the people who have very little information available tend to buy that. Always remember smart money. That means very big handles. The people who are extremely rich and powerful, who have hundreds of crores at their disposal, they have their own measures of due diligence and sources, so that they will be in general. It is said that smart money is always ahead of the general retail. Hence, when you come across the good news and you start buying, that is the time when they use this opportunity to make an exit. So always remember, good news is in most of the cases bad for the stock. So never buy stocks when it is making good news. So impact need not be as big as the news. News can be planted as well. Stay cautious. Say if I am a ultra rich individual and I have certain positions in a particular stock, I am not getting good prices. So I have to explore the ways of making an exit at good prices. Chances are also there that I may hire some PR agencies to run some stories on the stock, so that general people start buying the stock, and then I will be making an exit. This modus operandi is also very much possible. Hence, never invest on news alone. The next thing is never be adamant to learn. Of all the screenshots I had shared, this is the only place where I am sharing the actual losses that I booked. So this is the position I took, and this is the loss I booked. This is the only place where I am disclosing my actual losses. Why? Because this is the biggest loss I have ever clocked on a single counter, and whatever I have become today, that is because of this particular trade. This is the trade that turned my fortune, or that turned my thought process, or that turned my approach to the market forever. So I am always thankful to this loss that I have booked, so that I learned so much. So let me tell you the story behind this. This is never be adamant to learn. Never be adamant to learn from your mistakes. This is one of the major thing I would like to stress upon. Why? Because it is in our mistakes our lessons are lying. So never ever be adamant to learn from your mistakes. views do go negate, correct them instead of sticking. So this is somewhere I did my cardinal mistake. Let me share you the story. It was in the year of 2017 when IBC process, all of you must have come across from 2016. There is a bankruptcy code in place in India, and it is called Insolvency Bankruptcy Code. And it started resolving cases one after another. And it gained pretty much popularity and the success as well. On top of that success, there was a case named Electro Steel Castings Goa. There is a Electro Steel Castings company named Electro Steel, which was from Goa, which was acquired by the Vedanta Limited. Those were the days when I was simply observing the market and 50 paisa to 72 rupees, the Electro Steel casting. So I recognized one thing, that if a company is going through the insolvency bankruptcy code or the resolution process, there will be a new buyer at the end of the day or at the end of the year, and he will take over the company. From then, the stock will move like anything. So that was the time when this Ruchi Soya was also going through the insolvency process. I thought that now I laugh at what all the foolish thing I did. I thought that Ruchi Soya is going to be the next Electro Steel. Hence, I bought a very huge quantity of Ruchi Soya. As you can see on the screen, rupees 3,615 rupees was the price or was the quantity I bought. Rupees 44 paisa was my average purchase price. So I invested almost 27,000 rupees into this stock alone. Why? Because I thought this price is going to be multiple times higher than my buying price. But days passed, weeks passed, and months passed. But the resolution never completed. And me being a student, and you can also relate it with yourself, that students won't have much money to take such risky ventures. But I did give a try, and I did a very big mistake, that I invested into Ruchi Soya thinking that this is going to be a multi-bagger, but the resolution process never took off. It took very late after I sold. So I waited for almost 1.5 years, where my 27,000 rupees is parked. Neither it is making profits, nor it is giving me any returns in the form of dividends, nor I can use it. So my financial position became so bad that I had to book a loss of rupees 8,500 rupees. Why? Because my family didn't know that I have invested this money into the Ruchi Soya. How long I can peddle or how long I can trick my parents that no, I have given that money to this friend, that friend, and all. So it was almost 27,000 rupees. So the amount was quite big, and I was a student in Bangalore, and I had my own expenses. So this is where I had to book loss. I booked a loss of some 8,500 rupees, and this was quite big loss for me those days. So this is where I learned in market, for every lesson you pay, and these are the mistakes I did, and for which I paid this loss of 8,660 rupees. So this is the loss I booked, and from this loss I learned that never ever invest on news, never ever invest buy penny stocks, and also never ever compromise your lifestyle. So when I invested 27,000 rupees, I had to do so much of compromise with my lifestyle. Why? Because money was already there. If I am going to sell it, I had to book loss. On top of that, I am not even getting any money from that, so that I can meet my expenses. So I had cornered myself, or I had pushed myself to a situation that I had to make so much of compromises with my lifestyle. So that is one of the major lessons that I learned, and hence with all pride I am sharing with you the same thing. And one more task I would like to give to you friends. Can you please Google the price of Ruchi Soya now? I sold it for 5 rupees. Yeah, 840 rupees. How many of you believe that this is the same stock that went from 5 rupees to 840 rupees. Yeah, so let me put it this way. What happened was, before this stock moved from 5 rupees to 840 rupees, there is an equity conversion that happened. That means for every 100 old shares of Ruchi Soya, they would give a one new share. So if I held with myself those 3,600 shares, then I would be allotted only 36 shares. It is only after this conversion, stock moved from 5 rupees. So if I had to make big money, then I would have had to hold it. And even after so much of holding, I couldn't have made much money. Why? Because my average cost of buying was 7.44 rupees for one share. And my investment of 26,900 rupees would have turned to only 269 rupees. Why? Because for every 100 shares, only one new share I was being allotted. Hence, even if you see the screen and believe that so much of money has been made in Ruchi Soya, but that is not the case. So always know the complete story and never ever get carried away. And I did carried away because of electro steel, and I lost heavily. Next thing is, yeah. Yeah, Ruchi Soya is done. Yeah, this is one more thing I would like to bring to your notice. How many of you know the gentleman in this screen? Can you please, do you know who this guy is? Yeah, that guy is named Jesse Livermore. Jesse Livermore is one of the greatest traders, stock traders in the history of mankind, and he made more than 10,000 crore rupees. But the later part is he had to commit suicide. Why? Because he used to trade with the borrowed money. With the borrowed money, he used to take so much big positions that one fine day he found it was impossible to pay off the debt, and hence he committed suicide. So never ever take unnecessary risks. So not every risk you take is worthy of taking. Hence, stay away from unnecessary risks. Whenever if you buy what you don't want, then you will have to sell what you really want. This is one of the major lessons that we can draw from the life of Jesse Livermore. And incremental risk is no guarantee for incremental rewards. Just because I'm taking more and more and more risks, there is no guarantee that I will be making more money. Not every risk is worthy of taking. This is the takeaway. And next thing is, this is also from my trading chart itself. Never be too active. Trading or equity investment into the equity market is such a position that it is the work of a sniper. A sniper never shoots randomly. He has to wait for the best time before he finally shots. So, like a sniper, we have to wait for good opportunities. Else, if we start doing things randomly, this becomes a situation of any of us. So, if you see the screen, this is my trading in the month of August 2020 when I was hyperactive. Every day I used to trade, and I made some decent money in the first 2 weeks. And then one day, where you see the thick red, that is the day I made a good amount of losses. So 10 days of gain is wiped out on 11th day. That would be the case if you keep on trading very repetitively. Hence, stay away from being hyperactive. Why? Because even if you go by the statistical standards, probability always favors those who are inactive. Probability of success always favors those who are inactive. And next thing is, never have instant gratification. So there is a rule of thumb. If you are an agriculturist and if you have saw a plant of mango, you can't eat mangoes tomorrow. That is the rule of thumb. So never have instant gratification. We wait for so many things in our life. Market is also similar. So you all are CA students and you have to wait for a period of not less than 4 years to become a CA. If you have to wait for 4 years to become a CA, minimum 4 years, then why don't you wait for good returns in stock market? This is also one of the major learnings for us, that never have instant gratification and beautiful things take time. And also remember that there is no gain without pain, and waiting is the pain which you have to go through so that you can make some good gains. So there comes the 12th point, and here I would like to conclude this session by saying that never have, these all are the do's and the don'ts which we commonly do. Do's are the ones which we are desired to do or which we have to do, and don'ts are the things which we usually do. And this is the collection of my own experience. And when I started reading, I understood that investment has more to do with the behavioral science than with the statistics. So let me let me take you through what Mr. Parag Parikh has said. Parag Parikh is one of the legendary value investors in India, and he speaks a lot about the behavioral aspects. He says, successful people are simply those who make the habit of making what unsuccessful people don't like to do. And what are the things that unsuccessful people don't like to do? They are the same things even the successful people don't like to do. This is what Mr. Parag Parikh has said. Even if we keep the entire activity of trading and investment aside, what do the successful people do? They sleep less because they have to work. They focus more on studies because they want to do good things, or they want to become good people or great people or achievers in their life. And what do the losers do? They simply be lazy and don't study properly. Does it mean that the successful people don't like the reading, don't like the sleep? No, they also like the sleep as much as everyone else like the sleep. But they are aware that they have to compromise some of the comforts so that they can become good people or successful people in their life. So we all are patriots, and we all are aware of our NSG and other armed forces. They sleep only 6 hours a day, and for 18 rest of the 18 hours they will be working. So is it that don't they, or do they work for working for straight 18 hours? No, it is not that they like to work for 18 hours, but they are aware that it is their duty to work for 18 hours. So this is where the key thing lies. We don't like to work for 18 hours. They also don't like to work for 18 hours, but they are aware that they have to do even if they don't like to do. That is the key differentiator between the successful people and unsuccessful people. If we internalize our self-discipline, then it is only a matter of when, not whether, we become successful. So with this, I would like to conclude our session on do's and don'ts in equity market. And while saying this, I must also thank our Vijay Raja sir. So those were the days when I used to make big losses or taking some stupid decisions. I was feeling very low. And those were the times when our Vijay Raja sir encouraged me to come across the losses and stay tuned or stay ahead in the game. So this is the tribute I would like to give to him. Whatever I have become today, my journey began from 2000 rupees. Now it is in well above 6 digits. So I must thank him for always giving me the moral support that I always needed. So happy birthday, Vijay Raja sir, and my success is my tribute. So I was supposed to say this in the last week itself. As the time stretched upon, I am saying this now. So my thanks is to Vijay Raja sir. And I would like to thank you all for being actively patient listeners to this session. Now let me jump to the second topic. Yeah, that is mutual fund. So guys, can you see the screen? Can you see my screen?
No.
No. Just a second.
Earlier screen has not got stop share. Nitesh, you have to stop share that. Your old screen. Thank you is there. Now it is there, pros and cons of mutual fund.
Yeah, pros and cons of mutual funds. Yeah, so guys, we have come across with the behavioral aspects. Now this is not a behavioral aspect. This is just a this is a technical aspect which now I am going to tell with you people, and this is the pros and cons of mutual funds. So how many of you have come across the ads of mutual funds, be it in YouTube or be it in Instagram or be it in any other social media that you observe? Yeah, so a fair amount of you have come across the mutual fund ideas. And as Pankaj has said, if you are new to the market and if you are not aware of how equity markets function, but you want to be the a participant in equity markets, so then mutual funds are better suited to you. So let us go through the but before making our investment into the mutual funds, we must know the pros and cons, because if I am saying that there are only pros, then I am lying, and if I am saying that there are only cons, then also I am lying. So I am just giving you a fair idea of what will be the pros and what will be the cons of investing into the mutual funds. So mutual funds, this is a very common and popular tagline we all have come across. So, but I must say that the mutual funds are one of the most popular form of market-related investments, but things come with some strings attached. So these strings attached are the cons of mutual funds. So let me begin with the idea of mutual funds. So how does mutual funds work? So what is this? A term called mutual fund. So mutual fund is nothing but a vehicle for investment into different class of assets by pooling money from people. So this is like a reverse of banking aspect. So if someone are taking a big loan of some 100 crores to set up a factory, they won't have money. So they will go to the bank so that they can borrow and invest. But where does the bank gets its money from? It has to get the money from the general public, who will save 10,000 rupees, 5,000 rupees, 50,000 rupees, 5 lakh rupees, 4 lakh rupees, 3 lakh rupees. So the banker clubs all the savings, banker mobilizes all the savings, and then he lends. The mutual fund also works in a similar fashion. In mutual fund, what happens is, general people like me and you, all of us make our contribution to a mutual fund. There will be a fund manager who will be looking after the fund. Like a bank manager manages the operations of the bank, a fund manager will manage the operations of the fund. He will be the one collecting the funds from the general public. He will pool it together and he will invest into the market related and different class of assets. Mutual funds need not invest only into the equities. They will also invest into the debt securities. Debt securities may be RBI treasury bill or government bonds or corporate debt instruments like debentures or commercial papers, or they may invest into the real estate assets as well. So the fund manager will invest our money into all those assets, and from those assets, whatever the profit is being made, that will be distributed equally with all of us. To do all these things, he will charge some fee. So that is the professional fees we have to give. This professional fees can be in many ways, which we are going to discuss afterwards. So this is the idea of mutual fund. Entire investment process is managed by the professionals. These fund managers are not some random guys. They are highly qualified and well educated, and they are even well trained to manage the public money. The next thing is mutual fund industry in India. So let us see how big the mutual fund industry is in India. So on year end 2021, calendar year 2021, the total asset under management was rupees 37,72,696 crores. So asset under management is means all of us Indians have invested a sum total of 37 lakh rupees into mutual funds. So that is the total size. Just 10 years ago, the same amount was rupees 6,11,000 crores. So in the matter of 10 years, our mutual fund industry has grown by somewhat 6 times. This is a phenomenal growth. And number of accounts are 12 crore accounts. Mutual fund accounts need not be opened by the individuals alone. Many corporates or companies can also open mutual fund accounts, and they can also invest. So in all, over 12 crore accounts of mutual fund have been opened. The next thing is number of retail accounts. Retails are nothing but individuals like me and you guys. So there are 9.7 crore people in India who are making their investment into the mutual funds in one or the other way. Next thing is asset management companies present. That is 45. So asset management companies are mutual fund houses. The mutual fund house may be Kotak Mahindra Bank, or it can be HDFC mutual funds, or it can be ICICI Prudential mutual fund, or it can be State Bank of India, SBI mutual fund, and like that there are 45 mutual fund players who will collect money from these 12 crore accounts, and they will invest into the equity market and other related investment destinations like debt securities or real estate, etc. And like equity market, mutual fund is also governed by the SEBI, Securities Exchange Board of India. It will be acting as a governing body for mutual funds. And these 45 mutual funds have formed a voluntary association. When we were in college, there used to be a student union. Like that, there is a voluntary association of mutual funds, and it is called AMFI, Association of Mutual Funds India. Yeah.
So sorry to interrupt and participate in this throwdown, sir. Can you join them, sir?
Who?
Pavakarni.
Yeah, I have admitted.
Thank you, sir.
Yeah. So AMFI, Association of Mutual Funds India, is a voluntary association of mutual funds. So let us look into this aspect as well. How to buy mutual funds? So you can buy it directly from the asset management company, that is the mutual fund company. Say if I have to buy some mutual funds in Aditya Birla mutual fund, then I can visit to the Aditya Birla mutual fund office, and from there I can buy. Or I can buy from some distributors. Mutual fund distributors are like any other retail guys who will be opening their offices and sitting in their office. I have to visit to their office and I have to fill certain KYC norm. After that, I can buy it directly from the distributors. Next thing is from online. From online also, I can buy mutual fund units. I can even go to the websites of asset management companies, and from there I can buy mutual fund units. And last thing is from brokers. Even discount brokers like Grow and Zerodha, from their platform also I can buy mutual funds. So this is how we can buy. These all are the places from where I can buy mutual funds. Next thing is the pros of mutual funds. So let me take you through what are the advantages of investing into the mutual funds. First thing is, it is well suited for new beginners. New beginners won't have much idea of what to do and how to do, whether not to do, when not to do. These all are the common doubts new beginners will have. For them, it is well suited. Why? Because less homework is required. There will be a fund manager who will be looking after these operations, and his total time will be dedicated on the markets alone. So you can be stress free. You can if you are a student, you can focus on your studies. If you are a employee, you can focus on your job. You just have to put your money into the mutual funds, and you can live peacefully. So you don't have to take the stress upon yourself. And next thing is, you need not track investments continuously. That means every morning 9 o'clock you need not watch the CNBC, so that what is the price at which Sensex is opening. So at 3:30 you don't have to watch Z News, so Z Business, so that you can get to know what is the price at which Nifty is closing. So you don't have to take all those stress upon you. So you can you will, and on top of that, you will keep on receiving periodical updates. Say on at the end of every month, mutual fund will send you a report of what all are the things that they have bought and what all are the things that they have sold. So you will be receiving the updates as well. And you can start with very small amount. There was a Nippon India small cap fund in which you can start investing from as little as just 100 rupees. With just 100 rupees, you can start investing. Imagine that is how mutual funds reduce your burden. burden. You don't have to wait for so that you can make 10,000 rupees and then invest. You can start investing from as little as just 100 rupees. So that is the advantages of mutual funds. Second thing is relatively limited drawdowns. Drawdowns are the falls from the peak. So if it is at 100, to what extent it can fall? That is what something we call as drawdown. Here I have given a chart where the red color, which you see, is the performance of Kotak Flexi Cap Fund, and the black color lines which you see are the Nifty 200 index. So here, if you see the fall, the black colored line is steeper than the red colored line. So the index has fallen more, but the Kotak Flexi Cap Fund has fallen less. So this is not a recommendation, or this is not a holy grail or yardstick as such. This is just a narration of how mutual funds in general fall less than the market. So asset pool, why it happens is because asset pool may comprise of less volatile assets other than the equities. Say if the company is holding real estate assets, the company is holding cash, stocks can fall, but the cash can't fall. Why? Because it is a liquid position. And next thing is the pool of stocks act as a shock absorber. This is also one of the major things. Even if any one individual stock is falling drastically, there will be another set of assets or another set of stocks who won't fall that much. So this is how mutual funds are relatively with limited drawdowns. The beta of the portfolio is also very well known. Beta is an indicator of how weak your fund is against the market. So if the beta is less than the one, that indicates that for every 1 point, say for example, the beta of the fund is 0.5, then it indicates that for every 1 point fall in the index, only 0.5 points are going to fall in your mutual fund. Next thing is spread of risk. Assets of different nature are clubbed. In the previous session also, I showed you how my individual portfolio is diversified. So the beauty of mutual fund is that they also invest into a different class of assets so that the risk is spread. The thing that you see here is from ICICI Pru Balanced Advantage Fund. The fund has 33% of the holdings are from first 10 stocks, or next, or the 22% of the overall investment is invested into the top 5 holdings. And if you see, there is a even or uneven distribution of equity, cash, and debt instruments. If we look at this pie chart, we can say that more than 50% of allocation is not made into any of the single class of assets. So equities are a major component, debt is a relatively little component, and company mutual fund has a good amount of cash so that it can buy more if the market crashes. That is the advantage of mutual funds. Next thing is professional management. This is also from ICICI Prudential Balanced Advantage Fund. This is the profile of a fund manager. The name of the gentleman is Mr. Rajat Chandok. You can see his educational qualification. You can also see his experience, and you can also see the number of mutual funds that he has managed so far. Next thing is opportunity to invest into the global stocks. So when you have to I'm a big fan of Netflix, and I'm pretty confident that Netflix is going to be very big, but I don't have any means of investing into the Netflix directly. Why? Because I have to open separate Demat account so that I can buy the stocks directly offshore, or the price of Netflix stock itself can be too high for my budget, or I may come across with some FEMA regulations. So if I have to invest into a US equity, then I have to invest into the dollars. If I have to convert my currency, then RBI also comes into the picture. So there will be so many hurdles. But with mutual funds, there won't be such headaches. There are a number of mutual funds with global exposures. So that using by those mutual funds, you can directly invest into the global equities as well, apart from the Indian ones. Next thing is option to invest on a specific theme. Themes emerge with time. Say 30 years ago, there were no one saying good things about the solar. Solar was not even heard of then. But then the theme of solar emerged. The theme of renewable energies emerged in the span of last 30 years. So at every interval of time, new technologies and the new themes will be emerging. So when you are confused of investing into the selecting one particular stock, you don't you can instead you can directly invest into the pool of stocks belonging to the same sector. So the mutual funds can be relied upon when you are in confusion of selecting the particular stock. Say if I am bullish on IT sector, so I have money of 5,000 rupees and I am very much confused on whether to buy TCS, whether to buy Infosys, or whether to buy Wipro, or whether to buy L&T Infotech. That is the time when I can directly go to a technology focused mutual fund, and I can put all my 5,000 rupees into that fund. The fund manager will get that 5,000 rupees entirely, and he will distribute it among the stocks. So I don't have to select one winner for the at the cost of the another. So you can, when you are in deep confusion of picking the stocks, then you can rely upon the sector focused mutual funds. A sector focused mutual fund means if there is an IT sector focused mutual fund, it will invest your money only into the IT sector. So they will invest your money into the major players in IT sector. So you don't have to select any one stock randomly from the IT sector. Rather, the fund manager will invest your money into the every major company from that sector. So this is suited for zero sum games. Zero sum game is a concept in game theory where the gain of one individual comes at the cost of the another. So if Indian telecom market to consider, there were 14 players when Jio made its entry into the telecom market. Whatever Jio has gained, it is at the cost of the other players, be it from the Videocon also had its telecom operations. From Videocon, the Jio has earned. From Airtel, the Jio has earned. From Spice, the Jio has earned. From Aircel, the Jio has earned. So like this, when your gain comes at the cost of the loss of the another individual or another company, then instead of choosing, you can't predict who is going to be the winner. So if you put your money on both the players, then you will be with the winner automatically. So when there is a clear-cut case of the zero-sum game, you can rely on the sector-specific theme so that you will end up teaming up with the winner. Next thing is transparency in operations. Why there is a transparency in operations is because we must thank SEBI for the disclosure norms. They have made it mandatory. Your portfolio is fully disclosed. That means everyone will get to know what are the investments and what is the quantity of investment and what is the price of each and every unit, and the price is updated every day. After market hours, your mutual fund unit price is updated every day basis. So there is no chances of lying you or no chances of hiding any major managerial investment decisions from you. So everything is transparent here, and the position size is also closed. For example, if Parag Parikh is your mutual fund manager and they have bought Cadila Healthcare stock, they have to disclose what is the quantity of Cadila Healthcare they have acquired. So they can't hide any major decisions from you. Next thing is you can compare the returns with the peers and the benchmarks. So if there is a Kotak Flexi Cap Fund, you can compare the same with the Parag Parikh Flexi Cap Fund, and so that you can compare what is the return they have given and what is the return this fund has given. So there is that opportunity. This is also a major advantage of mutual fund. Next thing is tax benefits. So this is not new to you people, is something I believe. Why? Because under section 80C, there is a room for tax deduction up to 1.5 lakh rupees if you invest your money into the tax benefit mutual funds. Such funds are called ELSS, equity linked savings schemes, and almost every major mutual fund company has tax benefit mutual funds, and there is a limited lock-in period of 3 years. Say if you have invested 1.5 lakh rupees into a tax saving fund, and if you have not sold for next 3 years, then automatically you will be getting the tax benefits as well. These are the pros of mutual funds. Now let me take you through the cons of investment into the mutual funds. Cons are relatively less, or less severe compared to the pros. So let me begin with relatively higher cost. It is not that the mutual funds are costing you more, but relatively they are little higher. Say if I am buying stocks from Zerodha, then I am going to pay 0 rupees as brokerage. But that is not going to be the case if I am buying the mutual fund units of ICICI Prudential Technology. There I will have to pay some professional fees to the management of the mutual fund. It can be in the form of entry load. Entry load means whenever you are investing new money, at that time itself, mutual fund will get its fees. Exit load means whenever you are selling the mutual funds, at that time the mutual fund may receive its fees, or it can be annual charges. Annual charges means no matter what, as long as you are invested, pays some annual fees. The fees will be very minimal. I have to be true on that front as well. And charges are not linked to the performance. Even if your mutual fund is not performing, you can't say that I am not going to pay the fees. No matter what the performance is, you have to pay the fees. Next thing is too much of diversification. Whenever in the previous slide also you saw the mutual fund had invested into the 33 companies. Whenever you are diversifying too much, then again you are somewhere close to the risk cover. You are risk averse. If you are investing into the equities, that itself says that you are prone to the risk. So too much of diversification may reduce the risk by large extent. So with minimal risk, you can't expect bumper returns. So it will be in general above the inflation. So that is the one of the major cons of mutual funds. Next thing is large number of schemes. In India, there are hardly some 200 to 300 investment worthy stocks, but with them only there are some 2,500 plus schemes. This is a situation where old wine in new bottle. So the stocks will be the same, the fund name will be different. So that is also one of the major disadvantage of mutual funds. And cross selling of identical schemes. Like I said, in old wine in new bottle, the stocks will be the same, allocation will be little different, and that will be referred as a new fund. This is also one of the disadvantage of mutual funds. Next thing is no guaranteed returns. So risk is not totally thwarted. Though it is relatively less risky, I must say that it still carries an element of risk. So risk is always there. And then there is no guarantee of minimum returns, and it is prone to the drawdowns and losses. Despite being managed by the professionals and highly experted people, that still can't deny the fact that there can be losses. So this is also a major drawback of the mutual fund. The last thing is less control on your portfolio. Say when you have invested into the your money into the mutual fund, the fund manager will be the one taking the shots. You simply put your money into his hands and you just observe. So on a major basis, you won't have any major say in the managerial decisions. You put your money and you fold your hands and you sit. Rest of the things he will do. So by that you will have very little control on your portfolio. Almost no control on the portfolio. And you can't decide the stock, you can't decide the quantity, you can't decide the timing of buying and selling, you can't decide the prices of buying and selling. So everything will be taken care by the manager himself. And the last thing is cash drag. Cash drag means you have invested some money by thinking that this is the good time to buy the stock, but the fund manager thinks that this is not the good time to buy the stock. So what he does is he sits idly with the money. So this is what something I call as cash drag. Though I feel that this is right time to buy the stocks in the form of mutual funds, fund manager may not think the same. Whenever he feels that this is not the good time to invest the money into the stock market, you will simply keep your money aside and wait for the good time. So by this, your money will be made to wait for good opportunities. And this is what something I call as cash drag. So these all are the major pros and cons of mutual funds. Though I must say that there are some cons, the pros or the advantages of the mutual funds are outweighing the cons. So with this, I am concluding my short second session as well.
Thank you, Nitesh.
Yes.
Thank you for the wonderful session.
Yeah.
So as Nitesh also discussed, if you don't want to go directly into share market, then you can opt the route of mutual funds. You can go through SIP, you can do lump sum also. So I think SIP, many of you would be aware about. Monthly you can put certain amount into SIP, and that gives you a benefit of averaging of the price over the period of whatever investment you do. So many a times mutual fund performance, regular mutual fund performance depends on what time you entered into mutual fund, but the overall performance in case of SIP is much better than the mutual fund performance also, depending on when you entered into a mutual fund. Any questions you have on anything if we discuss? Nitesh, can you see any questions?
Yeah.
Ask.
Yeah.
Bharat is
So-
asking the question that is mutual fund worth holding compared to fundamental good stock? Is growth rate considerable? If growth is less than 8% per annum, we can buy tax-free bonds also or something like that.
Yeah. The case with bonds is returns are limited. You know what you are going to earn. But in mutual funds, that is not the case. Just because the mutual fund has not given good returns for last 3 years, that is not an indicator that that is not going to give small returns in next years. So that is again you have to take the call whether you have to hold on or whether you have to give up.
Nitesh, have we discussed CAGR into our slides anywhere?
No.
Okay, so can you just in 2 minutes discuss what is CAGR and how it is related to mutual fund?
Yeah.
Yes.
CAGR means compounded annual growth rate. So what is the on an aggregate basis, what is the return that you are going to receive from the mutual funds? We must also note that just because the CAGR of a mutual fund is 15% over last 5 years, we shouldn't be of the notion that every year it is going to increase by 15%. For there may be 3 years where it is not going to give any returns at all, and there can be a 1 year where it is going to jump the level and make new levels and sit there for the next 1 year. So we have to give the time to mutual funds before we judge the quality of a mutual fund. Any time period of greater than 5 to 10 years, then only we will get to know whether mutual fund is making exceptionally well or it is an average mutual fund. And one more thing also I would like to say is that, for example, the most of the gains that you see in the mutual fund are not annual ones. Like someone said the concept of bonds. If a bond is giving you an 8% return, then the interest you receive every year 8%. But that is not the case with a mutual fund. Say if a mutual fund is at 100 rupees today, and after 3 years, it may be reaching 160 rupees. That doesn't mean in the first year it became 100 to 120. In second year it became 120 to 140, and third year it became from 140 to 160. Mutual funds don't work that way. There can be cases when mutual fund in the first year can be moved from 100 to 90. In the second year, it might have moved again back to 100. In third year alone, it might have moved from 100 to 160. So you have to wait and you have to give the time as well. And if you are doing SIP, then instead of CAGR, I request you to focus on IRR, internal rate of return. Why? Because your cash flows are continuously inflowing. If you are buying in a lump sum and waiting for next 3 to 5 years, then you can look at CAGR as well. But if you are going for SIP mode, then you can also look into IRR.
Okay. Thank you, Nitesh. I just will share something which will give you a little more idea about mutual fund. As a just example, I have taken out this thing of Parag Parikh. Parag Parikh Flexi Fund. So whatever Nitesh has discussed will give this little idea in this one particular screen. The scheme objective of every mutual fund is already defined. It is equity and flexi cap. What is flexi cap? There are different kind of cap into a market, large cap shares, mid cap shares, small cap shares, large, and all these caps are depending on market capitalization. We discussed what market capitalization is. The share price into number of shares issued in the market is the total market capitalization of the company. So large cap, mid cap, small cap. So this scheme is into flexi cap, means the fund manager has flexibility to invest into different segment of large cap, mid cap, and small cap. He has that. We are, as a investor, giving that flexibility to him. The launch date is given. Every mutual fund's objective is already defined. Investment strategy, the scheme aims to achieve long-term capital appreciation by investing primarily in equity or equity-related instruments. The composition here, if you'll see, is 94.94, almost 95% is equity and 5% is into debt. Corpus is almost 14,590 CR, 14,500 CR. 52-week high, 52-week low prices are there. Then benchmark for this mutual fund, what would be the benchmark? Nifty 500 would be the benchmark that is available in the market. Scheme type, open-ended, fund manager. Every mutual fund has its own fund manager. Entry load and exit load is there. If within 2 years, 1 year, it is 2%. If it is, I think before 1 year to 3 years, it is 1%. And expense ratio is 1.85. So that is already given. And these are the different holdings, top holdings as on 31/8/2021. Of course, this is a little older record, but then Alphabet Incorporation, you know what that company is. Google. Is what Alphabet owning, So they have put in almost 8.5% of their total equity size. Then 14,590 crore was the corpus. Out of that 8.50, they have put it into Alphabet Incorporation, Bajaj Holding Investment Limited, ITC. So combination of large cap and small cap, and also Indian and foreign stocks. Microsoft is there, Amazon is there, Facebook is there, then HCL, Hero MotoCorp is there, Persistent is there, Emphasis is there. So not only all the large caps are there, mid cap and Sun Pharmaceutical here, Tata Motors are large caps, but at the same time, a lot of mid cap and small caps are also there. So this is how they have given the overall performance also of the company: 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, and 5 year. Since the inception was 2013, 10-year returns are not there. If you'll typically see, 1 year or 2 year returns are quite on a higher side because share market has moved that much in last 1 or 2 years. So that is the reason 60% or 40% is the return. But over the period of 5 years, it is still 22%. It's still 22%. These are the different sectors this company have invested in. I mean, I'm not kind of giving example that this is a very good mutual fund or not so good mutual. I'm just telling how mutual fund internally functions. And they always give the objective of the mutual fund, whether it's a large cap mutual fund, mid cap, flexi cap, or whatever. So depending on your investment approach, depending on your risk approach. I mean, large cap are relatively less riskier. Mid cap and small caps are relatively high risky mutual funds. But of course, as this is high risk, high the return, lower the risk, lower the returns kind of investment strategy that is there in all again into. So many of them ask, because what are the criteria on which mutual fund is to be decided. So as Nitesh also said, one of the major criteria into this is CAGR and IRR. I'll also just try to get another, I'll share another screen over here. That would give you a little more idea about different. So I have compiled 4 or 5 mutual funds into large cap, mid cap, flexi cap category, and these mutual funds are giving overall returns over the period of time. So this is AUM. AUM is asset under management, total asset under management. The 14,590 was the asset under management for Parag Parikh Flexi Fund. Now it is 14,190 or 2,126 amount into CR. NAV is net asset value. The way we have share prices onto stock exchange, NAV is the value of that particular share. That particular share ka price ho gaya. Sorry, mutual fund price. NAV is price of that particular mutual fund. And as Nitesh said, share market prices keep on fluctuating every now and then throughout the day. But mutual fund prices are declared at the end of the day after share market closes, and there is only one price for a day. it cannot be fluctuating NAV in a particular day. So that is how NAV has a 1 month return, 2 months return, 9 month, 1 year, 2 year, 3 year, 4 year, 5 year, and 10-year return. And since inception, last is since inception return. So in case of since inception, you will see almost all of them have given more than 20. One is 14, one is 16, and one is also 28. So if we'll take average of this just 5 funds, it is more than 21, 22% returns, which is incredible return, which is a very good return considering the other investment options. Even if you consider 10 years or 5 years, 21%, 16%, 18%, 22%, on an average 20% return is what this mutual fund have given in last 5 years or 10 years. Whether that will continue in the future or not is not very sure, but considering the story of India, economic story for India in next 10 to 15 years, people on the whole world is very bullish on Indian share market. So they are expecting it would do much, much better than that. So 18 to 20% CAGR is what normally people expect as of now from share market. Okay. Yes, there are certain expense ratios to different mutual fund, and depending on those expense ratios, I mean 100 rupees if you invest, they put in 1.5 rupees extra for the taking care of administration of the mutual fund, because in one mutual fund probably anywhere between 20 to 50 people, companies working on experts working on those different aspects, and to decide when to invest into anything or when to get out of any particular share and all that, so as to have maximum returns from that mutual fund. So to take care of administrative expenses, there is something called expense ratio. There is something called direct investment and regular investment also. I hope that is, I think that is not covered, Nitesh, na?
Which one?
Direct investment, regular investment?
No.
Okay, so just in 2 minutes, I'll close it and then I'll move to next chapter. So direct investment, something you can go on a mutual fund portal and invest it. And regular investment is there are enough consultants available in the market. They do their own study, and doing their study, they will suggest you or give you their consultancy. And of course, since the consultants are there in between, they would be taking some consultancy charges indirectly also. So the difference always between direct fund and regular fund, the return difference of the returns is close to 1% or little more than 1% also per annum. So you can decide on whether to go on a direct investment or whether to go with a consultant also. Of course, many of them go into direct investment because of the higher returns, and that is extremely simple process, very easy process, which you can really opt for. So I hope this is clear. So shares and mutual fund is what we discussed till now. Now I wanted to move to a next session. There are different Nitesh, you want to share something?
Yeah, there are some doubts our
Okay,
friends have shared in chat, and I will answer in chat itself that I wanted to.
Okay, you are answering there itself, right?
Yeah, yeah.
Okay, that's great, because we are little short of time also.
Yeah,
Let's move to,
that's why I will answer here itself.
Super. Right. So let's move to next part and different investment options that we have. Shares and mutual fund is one particular investment option we have, which is a very good investment option. Subject to we have all the financial discipline, because as Nitesh was saying all the time there regarding behavioral aspects, if anyone becomes little more greedy depending on the tips, this particular share if you take 2 दिन में double हो जाएगा, 3 दिन में ऐसा हो जाएगा, 2 महीने में ऐसा हो जाएगा, then if fundamentals are not strong enough, then there would be little issue. So let me take you to another different investment options that we would like to discuss today. Apart from the shares and mutual fund, and Vijay sir, Raja sir specially wanted me to take this because this would be little more important for yourself and from your family also. You can guide your family also on the basis of this particular discussions that we are doing. Right now, there is ROI is the concept that we all of us are aware about. Return on investment, we all are aware about it, right? Whether ROI, considering only ROI is enough for taking investment decision. If anyone is giving good ROI, is it enough for me to take my investment decision? Hari Krishna is saying no, Reshu is saying no. It's not sufficient, right? Sushma is also saying no. considering only ROI is not important, right? There are few more factors I need to factor in importantly. I mean, there are enough factors, but two important factors that I need to factor in before taking investment decision, you know. So, what are those two different factors, right? And just give me a moment, guys, just give me a moment. Yes, concept of effective return of rate of return, concept of effective ROI. So effective ROI is return adjusted for inflation. We all know about. While making an investment, it is very important that we consider effective ROI. Although investment may boast positive returns, the effective ROI return may be negative, particularly causing a loss. If effective ROI is positive, then we can go ahead with the investment. Two important aspects, friend. One is inflation and second is a taxation. Let me give you a very important insight. There is a survey that had happened and they says that 62% people doesn't take into account or have not taken into account inflation while making investment. They had not considered time value of money while making an investment. And imagine what kind of a horrible decision it would turn up to if they don't consider inflation into that inflation before making an investment, you know. So how do I calculate effective ROI? Actual return on investment minus income tax if it is applicable, and two, estimated inflation during the period, investment period. So if there is, say for example, I'm getting a ROI of 10%. Out of that ROI of 10%, what is my income tax applicable? If it is say 30%, so 3%, my 10% minus the 3% balance is 7%. And in my inflation, if estimated inflation is around 6%, then my effective ROI is only 1% and not the 10% ROI that I'm considering. It is only 1%. So it is very, very important for all of us to consider estimated inflation, estimated inflation and income tax rate. Friends, please understand something, and I'm making a very important statement. Fixed deposits in India to a large extent are being considered as investment options. Fixed deposits or FDs are still being considered to a large extent as investment option. And total Indians, there was a chart that had been published last month wherein they said out of total investments that Indians made, still the largest portion, almost 42 to 43% of investment that Indians made today as a totality, you know, is still into fixed deposits. Right? I always question my students that whether fixed investment can even be called as investment, whether fixed deposit can even be called as investment. And to my mind, FD on a literal sense cannot be even called as an investment. It is just a parking of your amount aside for certain purpose. For long term, making investment into FD really doesn't make any sense. Of course, it depends on your age and other more criteria also. But if I consider only from ROI perspective, making investment into FD, making investment into fixed deposit is not a very good idea. It's not, cannot be otherwise called as an investment also, because nowadays investment FD returns are 4%, 4.5% or 5% to the max. On that 5%, if you are into 30% slab, 1.5% is the income tax on the interest. You are left with 3 or 3.5%. And today inflation is anywhere between 5 to 6%. So are you even beating the inflation? Forget about positive returns. You are not even beating the inflation. You are below inflation. So FD in actual sense cannot be even called as investment. It is just a parking of your funds aside for temporary purpose. Yes, if you want to park it for say 6 months, 8 months, 1 year or so, it is certainly a good set. And I would certainly suggest you one thing which has helped me a lot in my initial career days, in my initial stage when I just had passed out my CA and started my practice. You know, what I used to do is I used to, of course, that time share market was not in that boom, and I wanted to invest for small term. I wanted to keep money out for small term. So recurring deposit is another option. Many of you would be aware about. So I used to take out that money from my account in a recurring deposit every month, say 5,000 rupees, 10,000 rupees, 12,000 rupees. And I used to make different recurring deposit, 5,000 ka alag, 10,000 ka alag, 7,500 ka alag. So that any given point of time, if I'm not able to invest the whole amount, I would discontinue only one RD and not the whole RDs. If at all I make one RD of 30,000 rupees, and if I'm not able to make it, then I need to discontinue complete 30,000 rupees RD. But I used to make 3 or 4 or 5 RDs of 30,000 rupees, total being 30,000 rupees. And then if at all I want to discontinue, I would have discontinued one RD. The benefit happened to me is over the period of 2 years, by these 5, 10, 15, 20,000 RDs, over the period of 2 years, I could get accumulated amount of 4 or 5 lakh rupees, with which I can purchase my first house. Of course, that time it used to, in 2000, it used to cost hardly 10 lakh rupees or 11 lakh rupees. But that time, because I had this margin amount, I had my own margin to invest in. Because if you go to home loans, buy home loans, they will first ask you to put in your own margin. And because I had this own margin, I could purchase my house and my office simultaneously next to each other, you know. So, I mean, FD and RD, you can still consider as parking of the amount for temporary time, but it cannot be considered as investment, right? So the Wikimantra, at Wikimantra, we says that investment funda is while making an investment, beat or at least meet the inflation. Beat or at least meet the inflation. If you are not able to meet the inflation or even beating the inflation, if you are below inflation, then the investment is certainly the negative investment, right? Many times we get this question, or people ask this question, I want to invest the amount, but what should I invest into? I have said 2 lakh rupees extra, what should I invest into? Now, friends, there is no standard answer to this question, because the answer will depend on a lot of different follow-up questions. What are the different follow-up questions when it comes to investment options, you know? And what is the best investment depends on 3 different criteria. Investment liquidity, how easily liquidable your investment is, how easily it can be liquidated, your risk and return approach, and 3, your investment timeline. Liquidity is how easily you can convert your investment into rupees or into your bank funds. So for example, if you have FD, if you have gold, it is very highly liquidable instrument, very highly liquidable this thing. Investment, you can liquidate into probably an hour or so, right? Can you give me some example which are not that highly liquidable, which might take little more time to get liquidated? What are the investment options? Bonds. Okay, Prajwal is saying bonds are a little which might take little more time to land and building. Naga is saying very good. Vinayak is saying gold, real estate, land. Vinayak, gold really is not that easily liquidable asset. It is a very easily liquidable asset. Of course, the price might be different, but you can simply go to any jeweler or any person and get it liquidated. ELSS has equity linked savings scheme has some lock-in period, so that is not easily liquidable. Real estate is one of the classic example of not so liquid assets, not so liquid, easily liquidable asset. It might take little time. It might take probably 15 days, 1 month, 2 months, 3 months time also to get it liquidated. And friends, that's the reason in a recession or in Corona, many of the builders struggled a lot, because many of them had a very good asset bank. Many of them had a very good land bank, but that was not easily liquidable, because the overall liquidity in the market itself had come down substantially. The people were not having enough money to buy those assets. Even if the builders or so-called big investor had a lot of land banks with them, the land banks were not easily sellable, not getting easily sold in the market. And that's why the liquidity was a big challenge at that point of time. Second is risk and return approach. So as we all the time discuss, higher the risk, higher the returns, lower the risk, lower the returns. What is your risk and return approach is what your investment decision can be dependent up to. Of course, there are certain ways through which at a lesser risk, you can still get a higher returns. But what is your risk and return approach is we need to take into consideration before making investment decision, and then investment timeline. What is your investment timeline, for how much period you want to invest it for? As I said, if you want to invest it for only 6 months or 1 year, then probably fixed deposit or some debt funds or some liquid bonds, liquid funds are different options to invest in. But so for the major mistakes many of the investors does is they make long-term investment into short-term assets and short-term investment into long-term assets. So FD, if you put it for 10 years, it is not really a very good thought or good option. But on shares, if you invest it only for 6 months, then again, it is not a very good option. So investment timeline is another important criteria, how much time you want to invest it for. Right? Long-term investment, short-term investment, we already discussed. Examples of long-term investment is share, mutual fund, real estate. And there is no definition of what is long-term definition, long-term as investment. The way we have definition for long-term capital gain, short-term capital gain in income tax, there is no definition for long-term investment in investment. It's just considered as minimum 2 to 3 years. In case of share market, it has to be even 4 to 5 years also. It depends on investment to investment. And short-term investment, again, FD, RD and gold if you purchased it for short-term. Risk and return, we already discussed that you might, the risk is the chances that you might not get returns you are looking for less than the expected returns. 2, you might not get any returns at all, 0 returns. And the risk on top of it is you might lose initial investment also partially or completely. If you are putting 1 lakh rupees as an investment into any investment criteria, you might lose your principal amount itself, forget about the returns. So these are the different risk and return criteria. Return is return on investment. We discussed that. This is also already been discussed about. Okay, let us jump to different investment option. And because a lot of girls are also there into this, I want to take up this particular investment option, which is gold, right? Very close to Indian people, especially Indian females. And gold is being all the time considered as to show off your wealth, or kitna jada aapke paas wealth hai uske liye. But then gold can be considered as a very, very, very good investment option also. So let us see how it can be a good investment option when it comes to gold, But these are the very interesting and kind of surprising, shocking facts when it comes to gold with Indian women. You'll be surprised to know how much gold Indian women have. As per WGC, that is World Gold Council, Indian women collectively own 25,000 tons of gold. That is 2.50 lakh kgs of gold Indian woman collectively owns. So the total worth of the same is 1250 billion rupees. That is 90 lakh crore, and that is the data is available on the internet, Google. This is 11% of the total gold in the world. The Indian woman has 11% of the total gold in the world. And this is also 40% of India GDP into 2019, right? I'm just sipping my tea as I'm discussing, friends. So these are the different gold with Indian woman. It's up to this level. So we can understand the love Indian women have for the gold, We all knew 1991 Indian economic crisis. Must have read it somewhere, must have heard it somewhere. In 1991, India was left with only 2 months foreign currency reserves. And India was almost on the verge of making default of its own payment obligations, which would have kind of impacted heavily had it happened, So India had only 2 months foreign currency reserves. There was a possibility that India will default on its payment commitments to oil and other imports, right? And that time it so happened, credit rating agency Moody's already had downgraded India's credit rating All major lenders, including World Bank, denied help to help India. And that time, India had to mortgage its gold reserve with Bank of England to save it from defaulting the payment. So 1991, very famous Indian economic crisis that had happened. And gold was something which came to rescue for India to get out of it. How gold is good investment option? Gold balances your investment portfolio. They always says one has to have a properly balanced investment portfolio. There cannot be only one fruit in the basket. You have to have all different investment options depending on its risk and return approach in your basket. So even if share market and mutual fund is extremely kind of promising investment in times to come, you cannot put in 100% of your investment into shares and mutual fund. Right? Experts says it can, depending on your age, it can be anywhere between 40 or 30 to 70 or 75% of your total investment. If you are younger, you can put in little higher. If you are little elder, you have to make the investment allocation of shares and mutual fund little lesser in your total investment portfolio. You know, gold investment gives good returns at a relatively lesser risk. Yes, there are risks because the rates are fluctuating, but risks are relatively lesser because the gold availability is limited, but then the requirement of gold as a population is growing and the requirement of gold is growing. You know, it will keep on growing, and hence the demand will keep on growing with the limited supply. Historically, gold has given a very good returns. The love, demand, and requirement of gold is ever increasing. Hence, it is a good investment. We can have its physical as well as electronic format. Very important. We can have it in physical as well as electronic format also. Income tax needs to be paid on the profit while selling the gold. That we all know. We all are CS students, you know. Now, let us just look into historical returns of the gold, which will give us little idea about how gold is a good investment or not. Right? We will just go back to say 65, say almost 55 years to understand how the gold rate has been moved till now. And let me here make a full screen so that you can get these numbers on your screen. So I have in left hand side in year column, I have taken every 5 years, because since 1965, 35 plus almost 20, 55 years, I have taken the rates into 5-year slab. And tried to analyze the returns that had given. And second column, the gold rates are there. In third column, net yearly growth is there. It's not overall growth, it's net growth. So in 1970, the rate was 184. So there was a 112 rupees net growth on 72 rupees. So on 72 rupees, if you will see the actual growth in 5 years is 155. Because on 72 rupees investment, we got 112 rupees as a returns, and total realizing final amount cost rate of gold was 184. So 72 rupees was investment, return was 112. So total percentage wise return was 155. 5 years. So like that, I have taken almost till 2020, and the returns in that 5 years, if you could have, if you see in 1, 2, 3, 4th column, 5 years growth in percentage terms, it is 155%, 193%, 146%. Sometimes it is of course 50, 60% also. Once in a 11 slots of 5 years, in one of those slots it is negative also. It is almost minus 6%, but almost all other places, at all other places, it is more than 50%. The gold rate is more than 50% in 5 years. You know, if I take 10 years criteria, 10 years slot, in 10 years slots, because 55 years data is there, there are 5 slots which are for 10 years. In 10 years slots, almost one time it is 650%, one time it is 294%, another time it is 276% also, which is close to 300%. Almost 3 times in this 5 slots, gold has given returns more than 300%. More than 300% return has been given. So that is another beautiful return that we can say. If it is 3 times or more than 3 times or close to 3 times returns are there. Of course, one time there it is even 49% return is also there. 119% return is also there in one of those 10% 10-year slabs. So these are the different growth rates: 5-year growth rate, 10-year growth rate, and these are the different growth options, returns that has been gold has given. So I particularly feel it's not a bad investment from longer term perspective to balance your portfolio. Again, I'm saying to balance your portfolio, it is not a bad investment. They are all saying that probably in 2025 or 2026 gold will become 1 lakh rupees, so on and so forth. But God knows what would be the price in time to come. But it is very good to balance your investment portfolio. So normally expert says whatever investment portfolio you have, depending on your age, again, you can put in anywhere between 10 to 15% of your total investment into gold. 10 to 15% of your total investment into gold. And another interesting way to analyze your investment also. Let me stop share this and just a moment. I'll stop share this and share one simple Excel sheet to tell you about few numbers. Many times this is how to understand. We are saying that in 5 years it is getting doubled, or 10 years it is getting tripled. So what is the ROI that is giving? If it is getting 3 times into 10 years, or if it is getting doubled into 5 years, what is the ROI it is talking about? So friends, in finance, there is something called Rule 72. Few of you must be aware about Rule 72. What does it mean? Rule 72 is, Rule 72 gives you idea about the time period in which your investment is going to double at. So 3 factors are involved into Rule 72. 1, what is the time period in which your investment will get doubled? Let me zoom this a little. Double. 2, what is the percentage ROI it is talking about? And 3, what is the period in which it will get doubled? What is the period in which it will get doubled? So if someone says it will get doubled into 5 years, so what is the ROI it is talking about? Okay, someone has unmuted. What is the ROI it is talking about? It is very simple. You can calculate the ROI within, say, 5 seconds if you have the time period in which it is getting doubled. So if it is 5 years, the simple calculation of ROI is 72 divided by 5 years. 72 divided by number of years. The ROI is 14.4%. For you to take a decision on whether it is a good ROI or not, Rule 72 will come to your help without using any calculator and all that. 72 divided by number of years will give you your ROI, that is 14.4%, right? If someone is saying, I will give you 12% ROI, I will give you 12% ROI. So how to understand what is the time period in which my amount will get doubled? Very simple, 72 divided by 12. 6 years. 6 years is a time period in which my amount will get doubled. So this is friends, Rule 72. Then there is something called Rule 114. Rule 114. What it says, in what period your amount will get triple? 3 times. So there we saw that in 10 years time, my amount got triple, or 675% returns I have got, or 300% returns I have got in 10 years time. So if it is 10 years, so what is my ROI? They are saying 114 divided by 10. The ROI is 11.4%. The ROI is 11.4%. If someone is saying in 8 years, I'm going to double the amount or triple the amount, right? 114 divided by 8, the ROI is going to be 14.25 rupees. So I'm giving a small kind of inputs to calculate the ROI or period without even having calculators or mobile calculators in your hand. Simply just like that, how can you do that? And there is something called Rule 144, which will give you 4 times of your amount, quadruplicate. In how much time or at what ROI your returns will get 4 times, right? Someone saying in 15 years, I will give you 4 times of returns. So it's very simple. 144 divided by 15. So your ROI is going to be 9.6% is what we need to understand. Just shared it because we were discussing about different ROIs in terms of gold. Is this clear to you? I'm not seeing chats, friends. So if you are raising any questions into chats, I might miss any of those questions. Okay. So have you understood this rule 72, 114 or 145? How to make it double, triple or 144? What returns or in what period it is getting double, triple and quadruplicate? Let me again share the same screen of the different investment options. Right. So this is gold investment, and you can certain, and best part is you can consider it in electronic formats also. There is ETFs, electric trading funds, or there is something very interesting, another initiative that this government has started with that I'll discuss in 2 minutes, which is called as sovereign gold bonds. Sovereign gold bonds. It is a very interesting initiative by the government. So sovereign gold bonds are issued by government India. It is perfect alternative to investment in physical gold. It eliminates risk of carrying physical gold, securing physical gold. Government issues a certificate for these bonds. It gives return in two ways. Very important. It gives return in two ways. One is rate appreciation. Whatever is your actual rate of gold, right, that will be applicable for you. That rate you will get benefit of. So actual gold rate is always available to you. And second, very important, you will get annual interest of 2.5% on the gold amount. 2.5% of annual interest. Till the time it was unheard of that physical gold you are keeping is giving you any recurring income in regular income. It was unheard of. But in this particular scheme, you will get 2.5% of annual interest in your account of whatever gold investment you have done. So sovereign gold bonds, minimum subscription is 1 gram to maximum is 4 kg per person. Very important, there is a lock-in period, 10 years of 8 years for this bond, because the benefit is available in two different aspects. One is interest benefit of 2.5% per annum. And another benefit I'll tell you just now. I'll tell you in time, a few seconds, but the lock-in period is 8 years, right? Very interesting is you can save income tax on appreciated amount after 8 years. You can save income tax. It's a completely tax-free investment. Otherwise, gold is subject to tax. Can you tell me in the chat what is the tax applicable on a sale of gold? What is the tax applicable on the sale of gold? Interest on face value, not on buy price, or correct, sir, for SGB. So Bharat, the interest is available on your investment amount. Right, face value will keep on changing, so it is difficult for anyone to give you that. For your investment amount, you will get that 2.5% investment returns. What is the tax applicable on gold? Can anyone tell me? Prajwal is saying, from where did these rules emerge? Is it art or an act? No, Prajwal, it is not an art. It is kind of basic mathematical calculations. And please understand that accuracy is 99.34%. It is not 100% accurate. Some 99 point some percentage of accuracy is there of that 72 and higher the period, the accuracy is more. If you consider it for 1 year, 2 year, the accuracy won't be there. Higher the period, accuracy would be more of this rule 72, 114, 114, 144. Yes, 22% is a flat income tax. So ratio, I'm talking about income tax as of now, GST I'll come to, but 20% is a tax applicable on sale while you make it. So because gold is a capital asset. Please understand, of course, indexation benefit is available when it goes to capital gain, but 20% is a tax applicable when it comes to gold sale. And in SGB, your 100% tax can be saved. So physical gold is dead investment. SGB can earn 2.5% investment. It is 100% secured as it is government initiative, right? So I'll just try to show you how this is SGB is such a wonderful investment over physical gold. So Okay, let me try to stop share this and share this with you. Are you able to see some physical gold and SGB on your screen? Okay, okay. So I'll just give you a small example how the investment in physical gold and SGB would be much different than each other. How SGB is much more beneficial than physical gold when it comes to investment. Imagine 2021 today gold price is 47,000 rupees, and 2028 is a lock-in period. So the amount becomes 1 lakh rupees. The price of gold in 2028 becomes 1 lakh rupees. So 47,000 is today price, 1 lakh is today price. In 1 lakh would be price into 2028. The gain would be, I'm looking into B column, physical gold. The gain would be 53,000 rupees. The income tax I'm considering 10,600. There would be indexation benefit, but for sake of calculation, I'm considering the total income tax is 10,600. It would come to 2,000, 2,500, little lesser than that. But for the sake of calculations, I have considered total amount as an income tax. The balance profit is 42,400. So on 47,000, we have earned 42,400. That is 90% of the returns. Right? In physical gold, of course, you have to incur GST also. So GST currently, I suppose on gold, it is 3%. There was talk or grapevine that the rate on GST rate on gold is going to become 4% or 5%. It has not happened yet. So while purchasing and while selling, both the times you have to incur that 3% of GST amount. So on 47,000, 3%, and while selling a gold, 3% GST price is there. If you factor in that, this return will come to anywhere between 80%, close to 80% only. Right? When you invest the same amount into SGB, that is sovereign gold bonds, the investment amount is another interesting task I need to do is keep unmuting every time someone or other. The return when it comes to SGB is 53,000 would be the gain. Income tax is 0 because the main criteria of tax SGBs, if you keep it invested for 8 years, your tax is 0. You will be exempt from income tax, and your balance profit is 53,000 rupees. And this 9,400 is 2.5% interest that you get for 8 years on 47,000 rupees. So on 47,000 rupees, you keep on getting interest of 2.5%. So that is 9,400. So 53,000 plus 9,400, 62,400. And then return happens to be almost 133%. My initial investment was 47,000 rupees. My total gain happened to be 62,400 rupees. And the percentage wise return, total return happened to be 133%. Have you got these calculations, or you want me to repeat anything again? And here, as is discussed in physical gold, I have not factored in GST also. In SGB, of course, there won't be any GST applicable because you are purchasing it in electronic format. 0 GST is applicable. So the returns are relatively better comparing to physical gold. Physical gold returns were anywhere between 80 to 90%. Here it is almost 133%, which is almost 50% more than the returns who are there. Right? So good investment option, because two important factors: they are giving you 2.5% returns, and 2, they are also giving you tax-free returns. They are giving you tax-free returns. Got it, sir. Got it, sir. Got it, sir. Bharat is asking, what about tax application on interest from SGB? It is applicable. Tax on 9,400 is applicable, but that's why I'm saying you here. I have not factored in GST. That's why I have kind of ignored the 30% of tax on that also. So here it would be otherwise effectively 80%, and here it would be effectively 125 approximate percentage, or 125 to 130% if I factor in complete GST, income tax, indexation, and everything also. But point I'm driving here is sovereign gold bond is much better relatively than physical gold. much better relatively than physical gold. So if at all you are, and then the sovereign gold bond is not readily available everywhere. Government comes up with this issue of sovereign gold bonds almost every month. We at Wikimantra will keep informing you. Now that you have becomes kind of learners into Wikimantra also, we'll keep giving you the small updates every now and then. You please save one mobile number that I'll be giving you in a chat as a Wikimantra number, you can say so. And from that Wikimantra number, even after these sessions, almost every week we'll keep you posting small something or other input relating to financial management, financial awareness, financial discipline, latest things that is happening into finance, right? Any questions as far as this physical gold, SGB or gold investment is concerned? Any questions do you have? Bharat is saying everything is fine, sir, but if I tell my wife SGB instead of gold, she'll kick out of my home. Sorry, Bharat, if that happens, so please don't tell her that I have given you this idea, because then she will keep searching my home also. So, but then jokes apart, friends, it's certainly a good investment option. Prajwal is saying, how do we purchase it? It is available on different banking platforms and government platforms also. Government issues those sovereign gold bond issues almost once in a month. It is open for 3 to 4 days only. You can just kind of keep Googling it, keep searching on a Google when the next issue of SGB is there. And I can strongly recommend you that small amount. Of course, the investment period is 8 years. Please remember, investment period is 8 years. So if you have that capacity to keep invested for 8 years, then only you'll put in. But you can suggest it to your family. You can suggest this investment option to your family. And of course, I need not to tell you, if at all you are investing it because it is online transaction, because it is electronic format, only white amount you can invest in. So unfortunately, if you put in black amount and it happens to be a kind of any issue further, you please note that white transactions only can be done because it's in an electronic format. Can SGB purchase anytime, Pramukh? I already replied. The government keeps issuing these bonds once in a month, and then only you can purchase it. Is there any minimum amount of SGB? Yes, I think in that slide I showed something around 100 rupees, 1 gram of gold also, I think you can start purchasing it from. So I think very small minimal amount also you can start purchasing from. Yes, Bharat answered it. Can it be traded in a market? No, Gagan, you cannot really sold it. In emergency, even though locking period is 8 years, for emergency purpose, for any reasons, you can always come out of it. Of course, there would be some penal consequences, some tax amount would be there, or some return investment reduction, return in interest reduction would be there, some penal consequences, but you can always come out of it if at all there is some emergencies thing is there, Prajwal, cause I have seen your presentation, minimum investment of 1 gram, right? 1 gram is 50,000 approx. No, Prajwal, 10 gram is 50,000. 1 gram is only 5,000 rupees. So, yes. Hara Prasad is asking, if I purchase 1 lakh worth e-gold and sell e-gold after 2-3 years, will I get money back equivalent to market value on the date of selling? And what about applicability of tax and commission on the same? So in ETF, even in electronic traded funds, ETFs that is available, your tax is applicable because there is no locking period. Tax is applicable on ETFs and physical gold, of course, yes, there is no doubt on that. Only in SGB, because locking period is 8 years, because government will be using this amount for its own purpose for 8 years, you are getting that benefit of tax exemption plus this 2.5% interest also, so you can suggest this to your families, what would like to share with you, right? This is 4:55 already, so would like to conclude it, and there are 3-4 different investment option and few more things would like to share with you on next Sunday. Friends, 1 or 2 very important aspects need to consider at this stage of life when you are a student and when you will be start earning good amount in very soon time to come. Yes, number. Pawar number you are asking, please let me just check that number and put it into chat. That is very important. I'm putting that amount in number into chat. Nine 9808511511. 9808511511 is the mobile number. You please save as a Wikimantra number. Of course, you must be getting some WhatsApp message and all that from some different number. Let that also be there. But if you save this number, normally what we do is after every such sessions, we create a broadcast list and keep sending these inputs on a broadcast list. In a broadcast list, if you have not saved the number, then you don't get the message. You get the message only if you have saved this number as a Wikimantra updates. You can say as a Wikimantra updates or whatever you want, which will keep on giving. And when SGB issue is happening next and something like that is there, so we'll keep you doing it. Do you have a Telegram channel, Bharat? We don't have, but we'll be starting it very soon. That time you'll come to know about it. Two important things, friend. What I did good and what I did not did good at that point of time when I was of your age, probably 18 or 20 years earlier. One, as I said, I used to keep on stretching myself a little when it comes to saving. I used to keep on stretching myself when it comes to saving. If the possibility was 5,000 rupees of save, I used to stretch and save 8,000 rupees. And I used to do that give standing instruction to my bank that for 8,000 rupees, you please take out from my account immediately. Don't keep it lying in my account, because if there are accounts, I'll use it somewhere else, So stretch yourself little more when it comes to saving. Right? Where to save is what we are discussing. Share market, gold, short-term investment, long-term investment, and all that. You need to do it very smartly. Please don't invest into long-term investment if you want to have a short-term return, if you want that money in a short term, right? But please stretch yourself a little and invest in it. So very small portion, because you would be needing a lot of funds in time to come for your house purchases, for a lot of your dreams to complete. You will be needing money. So for a long-term investment like shares and all that, you cannot keep larger amount. You can start with a smaller amount. For example, if you are able to save 10,000 rupees every month, probably save 5% or 10% or 15% into shares. Try to create a corpus. Try to create a corpus by saving it or parking that amount aside into recurring deposit or into liquid funds or whatever, wherein you can just park it aside. Whatever interest or return you are getting, it is a bonus. You consider it as. Don't look into that interest. If 3% interest, only 4% interest, I'm not getting more interest, so what to do with that? Don't even look at that interest. You are just try to park that amount aside and try to create a corpus of 2 lakh, 3 lakh rupees or something like that after 1 year, 2 year or whatever period, which will be very important for you to create a very good bigger investment. For example, your first house or any other investment that you want. But very important, stretch a little when it comes to saving and investment. And two, most important thing is, always remember needs and wants that we discussed last time. Wants, certainly we need. Wants, jindagi na milegi dobara, we already discussed and all that. But try to curtail it as much as possible. I'll give you a small example which will give you a very good amount of clarity that how it can happen. We used to have, my colleague was Vinod, when we used to stay in a hostel in my CA days, and my Vinod was there, and Vinod was very kind of financially low background, and he was not able to afford a room also. For some many days, I remember he used to sleep in the gallery or corridor of the hostel, when he came to the hostel, because he couldn't get admission into the hostel also. And then he got into industrial training into CA days, and after that industrial training, he was getting some extra amount, all that. In that also, he kept on saving the amount, and that from those days, when we never even thought about saving, hum to pura masti karo, enjoy karo, wo mood mein rehte the. He kept on saving that 500, 200, 300, 700, and since that time he used to keep investing into share market and all that. You won't be able to imagine the Infosys that he had purchased had given him returns of few thousand percentage. because he had purchases Infosys that point of time, say for example 100 rupees. Now after that 100 rupees, he got probably 5 or 7 different bonuses. On top of it, the Infosys got split multiple times. And after doing all that, the ratio today Infosys is at 1700 or 1800 rupees. Can you imagine that? With that bonuses and split, his price was hardly anywhere between 5-6 rupees purchase. And today Infosys is trading at 1700, 1800 rupees. Because he's my good friend, I can tell you today his investment portfolio is at age of 45, anywhere close to 70 or 75 CR. The person who was not getting place in a hostel because he was not able to pay his hostel fees. And we were the people who like masti karenge, ye karenge, enjoy karenge, hotel karenge, wo karenge, you know. And now today, I mean, the kind of life, I mean, just to compare, you know, early saving habits can give you phenomenal results. So whatever income range you are at, state you are, please start investing these small amounts. We want to enjoy the life. We want to have that wants, so-called wants in a life. But please ask this one question all the time: is it really necessary? Is it give me that kind of a satisfaction which is worth it? Otherwise, shall I put it that time? Do I want to become another Vinod? Shall I just put it into one of those investments? All that. Please ask this one. Let that be one particular filter. Is this very important? You remember last time we discussed 18% return, 50,000 can become either 3.75 crore or 102 crore, 3.75 crore into 40 years or 102 crore into 60 years. Right? If you are into 20 years and if you are putting it that 50,000 rupees amount, do you want to miss that 3.75 crore rupees that you can get it at a retirement? Is one filtering question you need to ask yourself all the time, right? One small request to all of you before we depart. Next time, we'll be discussing another interesting options to you. Dhruva would like to know your perspective on one of the schemes like PPF. Of course, PPF and Sukanya Samruddhi is one of the very interesting initiatives I'll be discussing with you. Bharat is saying, my CA sir Mandana is inspiration for investment. Would like to thank him for teaching. Absolutely. All your teachers whom sir investment taught you about investments, about these savings, you should have a gratitude for them and you should start doing it. You know, small request to all of you is, of course, in first session, I already did this. Please take out your mobiles. Please take out your mobiles. As I discussed on a Wikimantra, we have Insta channel, Facebook, and YouTube also. You know, my request to you is before leaving this, please like, subscribe, or to this Wikimantra YouTube channel, Wikimantra Insta, Wikimantra Facebook, LinkedIn also. And once you're done, please put done sir as a chain to chat. Complete it and put it into chat. You will keep getting these small inputs about different investment options, about different finance related topics, about related different topics. One small thing I can tell you, which can see, one of the small inputs also can change so much saving from our side. You know, I always keep telling, and this is very important input for all of you also, you need to be insured adequately. But insurance is not equal to investment. Please don't consider your insurance as an investment. This small input can help you a lot. Almost, friends, 54% people today consider insurance as an investment. They consider insurance as an investment, and after 20 years, I'll get this particular amount, I'll get this maturity amount, and all those kind of things, you know. So please don't consider insurance as an investment. These are the small inputs. Like that, there are many inputs we keep on giving you through this Insta or Facebook pages or on YouTube videos and all that. So please do all four. Those of you who have YouTube, Insta, Facebook, and LinkedIn, that will help us also. And requesting you to spread the word about Wikimantra also. This is a small initiative for us. Imagine, friends, we being finance student need this so much. What would be the condition of non-finance students? From engineering, from medical, from legal students, law, architect, you know, journalism students, they are not aware about anything. CAGR kya hai, you know, effective ROI kya hai, ye kya hai. See, people make enough financial mistakes and learn out of it. But through this financial mistake, friends, three things happen. One, your amount is wasted. When your money is lost. Two, your time is wasted. And three, the energy is wasted. So why do you need to waste all these three things if you can learn it, if you can have it already, you know, if you can know it already. So please, I mean, spread the words about Wikimantra. At Wikimantra, we conduct financial literacy courses for college students, for teenagers, 9, 10th, 11, 12 students, homemakers, housewives. Many of our mothers needs it a lot. She's not aware about insurance. She's not aware about SIP. She's not aware about so many different options, and that cannot be the case now. आज उनको जरूरत है ये सब सीखने का. So homemakers and for businessmen and professionals also, we have a separate category of finance courses, and we do it only in 20 sessions. I'll give a little more detail into next sessions. Thank you so much. So many of them, Badri, Dhruva, Dhanushri, Pramukh, Deepa. Many of you have done it. Kritika, Gagan, Ramesha, Shambhavi, so nice of you, dear. So nice of you. Thank you so much for doing it. Please do it all. Please, 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 requesting all of you to tell your friends. At least in your family, you will have 2-3 more members. From that, please subscribe to all these 4 sessions. That will help Wikimantra a lot to spread this financial literacy awareness among us. Next Sunday, we are meeting at 3 o'clock with another interesting session. Thank you so much, guys. I'm really enjoying this. I'm really enjoying this. And probably if you have think you must have been already aware about also. ऐसा नहीं कि everything is very new to you or you're probably, but you would be getting different perspective, different approach, or even if probably smallest of insurance is not equal to investment, that one particular input also would be more than sufficient for us to avoid a lot of financial mistakes. Simple as that. 54% people makes the investment, makes the mistakes. And if I'm not among that 54%, that itself would be worth these 2 hours of investment, you know. So next week also we'll be discussing another lot of different investment options like this, and would try to cover as much as possible. Thank you so much, guys. Thanks a lot. Looking forward to next Sunday. Kavita is asking, is opting for LIC plus good or bad? Instead of LIC, can we jump to stock market? Kavita will be discussing in next session about investment in a proper way. This thing, please ask this question again tomorrow, because today we need to done with. Thank you so much. Thank you for that Insta, social media campaigns and all that. Thank you, guys. Please enjoy yourself.
So next week class at 3 p.m.
Next week class is
Next week.
3 p.m. Next week there is no separate class at 2 p.m. because this time we want to learn basics of share market. That's why I took it. Next time again 3 p.m. Earlier it was scheduled for 3 to 4 p.m. but please keep little more time, because since you are doing it so well, you know, I would like to stretch it little more, so might take it 1 more extra hour next week also. So probably keep that 2 hours for next week. We'll be discussing a lot of the small interesting inputs in next week. LIC, PPF, Sukanya Samruddhi, real estate, you know, and a few more different things also we'll discuss in next week. Thank you, guys. Thanks a lot. Take care.
Thank you, sir.
Bye. Enjoy yourself.